Good evening, everyone. I hope I am audible to all of you. I hope I am audible to all of you. Please chat up. Hi in the chat box. Let us wait for everyone to join in. I am joined in and time is 8 o'clock. Please type a hi in the chat box so that I can be sure that all of you are able to hear me clearly. You are able to see me clearly. And please tell me, how was your FR examination? Was it all good? Hi Rashmi. All set? We'll just wait for 1 minute, friends. Let everyone join in. FR was average. Good evening, Riza. Good evening, Arvind. Yes, preferably keep the ODB book with you because that is what I'll be covering here now. Hello, Ashwin. Hi, Dakshin. Hope you're all doing good. Good evening, Logeshwari. We'll wait for exactly 1 more minute and we'll start off. I can totally understand that FR would have had a drastic effect on all of you. Many of you must be exhausted. That is the reason we are doing this Forex Marathon today, so that you all can finish off this one major chunk even today night itself. So tomorrow onwards, you can focus on the other easy topics. Okay. This is something what I call it as swallow the big frog. So once this big frog is swallowed, you can easily focus on the other topics. That is the whole idea of what we are doing right now. Okay. So I think all of you are live. Good evening, Swati, Rihas, Shreyas, Anila. Good evening, everyone. I think we don't have to waste any further time. Shall we begin with our session now, friends? Are you all ready? Perfect. Friends, even before we start off with, hold on, I just need to share this link with just one more person. Yeah, Shreyas will have only a Forex marathon today. Tomorrow, it's better you do self-study. If I sit and teach you everything, I might not help you so much today since you're all exhausted. We will be doing this part over here. Sajin, I'm doing Forex problems. That alone will take 4 hours. So by the time it gets over, it will be 12 o'clock or 12:30. If I go ahead and take theory after that, it might be very, very exhausting for all of you also. Yes. So friends, even before I start off with the Forex marathon, okay, point number one, let me give you a quick study plan about today, tomorrow, and Sunday. So today is Friday. Friday, you finish off with Forex. One major chunk will be over with this. Sleep well, get up. Tomorrow, do all the easy topics which gives you more marks in less time. So morning, you start off with bond valuation, share valuation, or you can call it together as a security valuation. Then you do mutual funds. Okay. Follow it up by mergers and business valuation. These are all easy topics. It will all get over from morning. Let's say if you start by 7 also, you can finish all these by 12 o'clock. All right. After this, take a break. And after the break, you can have two sessions. Second session can be portfolio, 2 p.m. to 5 p.m. That is a crucial time because that's the time when your brain needs to work out a lot of time. So this should be given the time from 2 to 5. This all should be before 2. All right. After 5, you will have to work out only the advanced capital budgeting. That will be the only one major chunk that is left. So you can do it from, let's say, 6 to 8. And you can sleep. Last day, that is Sunday morning, when you wake up, first thing you do is derivatives. So when I say derivatives, you can start from 5 a.m. in the morning and you can go up to 9 a.m. max. Not beyond that, 4 hours. You can do futures, options, and interest rate derivatives. All these topics you can complete. All right. After 9, do not touch any more problem part because it will exhaust you when you go to the examination hall. After 9 a.m., all that you have to do is you have to just go and work out the theory marathon. Are you clear with this part? So this is going to be the plan which you're going to follow for the coming 2 days of time. Are you all clear? Please type clear in the chat box. And if you are ready, let's go and start off with the Forex Marathon. Perfect, friends. So let's not waste any further time. Let us start off with the Forex Marathon. So to do the Forex Marathon, I will be using my ODB material. What is ODB? 1 day before the examination. All right. So in this material, what we normally do is we'll cover minimum questions that cover the maximum areas. So in this, I have made a set of questions which covers almost all the adjustment in limited number of times. So that starts from question number 1 and it will go up to, one moment. From question number 1, it can go up to, or hold on, I'll just open it with another. Yes, this is better. Okay, I will go up to, I think, question number 20 if I'm not wrong. Let me just confirm it right away now. There are some 15 to 20 questions which are all unique, or maybe 15. I need to confirm it, I'll tell you. 12 is important. 13 is important. Up to Nostro. So that is up to question number 15. Okay, 15 is also very good. So up to 15th question, we'll work it out now itself. So once we are done with these 15 questions, you would be covering all the conceptual adjustments of Forex. Then there can be a little bit more of the problem which you can scribble and solve. Logeshwari, remaining 5 are repeated problems. If we get time, we'll definitely do that also. All right. So let's not waste any further time. Let us start off with Forex question number 1. So even before I do question number 1, friends, let us just discuss the concept of currency commodity. Numerator is always the currency and denominator is always the commodity. Everybody clear? Then we learned about bid, ask, spread. Bid means what? Bank buy commodity is called as bid, and ask is what? Bank sell commodity is what we call it as the ask rate. Spread is what? It is the difference between the ask rate and the bid rate is what you call it as the spread. Everybody clear with this part? Okay. So now in this, we have a question now. A two-way quote is given. So any question you do in the exam, start with working note number 1, basic data. Why are we doing the basic data? Very important from AFM because here we are trying to understand the question. Is everybody clear? We are only taking efforts to understand the question. So here they have given you the spot rate and they have given you the forward rate. Friends, I'll share this PDF in the mentoring group after the class gets over. So you can just quickly read through it also. Now you don't spend time writing everything that I'm writing. Scribble and solve. I'll keep on writing and solving it. All right. They have given you the spot rate. What is the spot rate given over here? 46-46.25 rupees per dollar. Then they have given you the forward rate. 47-47.5 rupees per dollar. Now with this data, they're asking you how many US dollar a firm should sell to get 25 lakh rupees. So I'll write down working note number 2. Dollar to be sold to get 25 lakh rupees. So first and foremost thing over here is we need to understand whether it is going to be a bid rate or whether it is going to be an ask rate. Now this is the diagram that I do in my classes. exam point of view, just visualize this diagram. But here I'm drawing it so that you get clarity on what we are doing. Okay. So now, first thing, how many dollars has to be sold? So what are you going to do over here? Sell dollar. In return, what will you do? Buy rupee. What will bank do? Sell rupee, buy dollar. And the exchange rate is rupee per dollar. Friends, I hope I am audible. If I am not audible, tell me, I'll increase the audio. Okay. What is the commodity? Dollar. What is the bank doing? Buy dollar. So what rate is applicable over here? Can you tell me? It is going to be the bid rate. Everybody clear with this part? Bid rate is applicable. So now if the bid rate is applicable, can you tell me what was the amount that they want? You want 25 lakh rupees. Are they asking now or after 2 months? After 2 months. So when I say after 2 months, will it be the spot rate or will it be the forward rate? It will be the forward rate. All of you keep on talking with me, even though I cannot hear you. Keep on talking with me, okay? So what is the forward rate that you have over here? 46.25 rupee per dollar. So will you multiply or divide? You will divide because only when you divide rupee will get cancelled. If you multiply, you will get rupee square, correct? So now tell me, hold on. How many US dollar the firm should sell to get 25 lakh rupees? Correct. So we have 26. Sorry. I have taken the wrong rate. It is the forward bid rate. What is the forward bid rate? 47. I have taken the wrong rate over here. Sorry, friends. It is a forward bid rate. 47 rupees per dollar. So you have to divide. So what is 25 lakh divided by 47? Do you get the answer as $53,191 over here, friends? Am I right? Okay. So you get $53,191. That is the answer for the first one. That is dollars to be sold. Everybody clear with this part? Okay. Next. After we are done with the first one, second question they are asking, how many rupees is the firm required to pay to get, I think there's a typing error over here. We should get the answer as $2 lakh. Okay. $2 lakh in the spot market. So now in order to get $2 lakh, so action to get $2 lakh, that too in the spot market. So now you have to get $2 lakh. Again, when I draw the diagram, you have to get dollar means what are you going to do? Buy dollar. In return, sell rupee. Bank is going to buy rupee and sell dollar. Rupees per dollar. What is the commodity over here? Dollar. What is the bank doing with the dollar? Sell dollar. So what rate is applicable over here? It will be the ask rate. Spot ask rate. So now they want $2 lakh. Correct? What is the spot ask rate? 46.25 rupees per dollar. What will you do? You will do multiply. Do you get the answer as 92,50,000 over here now? Yes, that is the answer you get for the second one. All right. Yes. After we are done with the second part also, now we have a third part. Assume the firm is having $69,000 in the current account, earning no interest. So now what is happening? This person has $69,000 in the current account. He is having two options over here. Option number one, right now he's getting no interest. Whereas if he converts into rupee, he will get 10% interest. So he has got two options now. Option number one is what? Encash now. So convert into rupee now. What is option number two? Encash later. Let us say he's going to encash this money now. In that case, what will happen is $69,000 he's having with him. What will he do with the $69,000? He will sell the dollar. What is the bank going to do? Buy the dollar. In return, what will the bank do? Sell rupee. Correct? What is the commodity over here? Dollar. So bank buying dollar means it's going to be the bid rate. So what is the spot bid rate? Is it 46? Now tell me. So you have 69,000 into 46. 31,74,000. On this, you will get interest at the rate of 10% for how many months? 2 months. Do you get the answer as 52,900 rupees? Correct? So 31,74,000 plus 52,900. Do you get the total value as 32,26,900 over here? Now, if you are going to encash later, in that case, what will happen is you will have $69,000 plus your interest will be $0. So your closing value will be how much? $69,000. After that, the exchange rate is 47 rupees per dollar. So when you do like this, you will get the answer as 32,43,000. Now tell me which one is giving you more money, Encash now or Encash later? Encash later. Hence, this should be the answer. Friends, I have given the answer in the chart format, but in exam, you should give point by point. Okay. For example, you should give opening balance, interest, closing balance in dollar, exchange rate, and then what will you write down? Closing balance in rupee. Like that, you should give point by point. Since I want to explain the logic to you here, I am doing it in a chart format. Friends, with this, we are done with this question. So what did we do? We wrote down basic data, then we wrote down the analysis. Finally, you should give conclusion. In conclusion, just give the final answers, friends. I'm not doing that here since it will be wasting of my time. So I'm not doing that here. But in exam, please do write the conclusion also. Now I'll give you a 1 minute cool off time. Quickly go through this. Any doubts, you can message me. After which we will go to the next question. Like that, after every question, I will be giving you a 1 minute cool off time. Please go through it. All right, friends, can I go to the next part now? Are you all clear with this one? Right. Let us take the next question now. Friends, the next question, I think everything is solved over here also. You have the data given, but I wanted to solve it out so that you get the clarity on the entire thing. Second question is on swap points, appreciation and depreciation. Okay. So swap points means what? If swap points are in ascending order, you add. If swap points are in descending order, what do? You subtract. Appreciation means if today the spot price is 50, tomorrow it becomes 55, I would say dollar is appreciating. Today the dollar is 50, tomorrow dollar becomes 45, I would say the dollar is depreciating. Everybody clear with that part now? Okay, so now here they have given you the data. They have given you the spot rate, 2 months swap points and 3 months swap points are given. So we'll write down question number 2. Working note number 1. Basic data. Particulars, bid, and then you will have ask. Point number A is what? It is the spot rate. So what is the spot rate? 66.2525, 67.5945. Okay, then they have given you the 2 months swap points are given 70, 90. 3 months swap points are given 160, 186. From this, they have told below that in a spot transaction, delivery is made after 2 days. So now what happens is if April 1st is when you execute it, it will be April 3rd when they will deliver it. Okay, so here they have a delivery date of how many days? 2 days. Assume the spot date is 5th April. On top, they have given 3rd April. So 3rd April you enter, the spot date is 5th April. Now they have told one swap point is 0.0001. That is basically because there are 4 decimals. 4 decimals, 0.0001. Okay. Now they are asking you to find out the swap points after 2 months and 15 days. That is from 5th April, it will be June 20th. So 2.5 months is what they are asking. So here I'll write down 2.5 months swap point. So what is 70 plus 160 divided by 2? 115 divided by 2, 138, correct? So after you get this, I can go and find out what will be my 2.5 months forward rate. So 2525 plus 115 will be 2640. Okay. 5945 plus 138 will be 6083. This is going to be your forward rate. Is everybody clear with this part now? So like this, we have got the first answer, that is 2.5 months forward rate. We got the swap points also. We also got 2.5 months forward rate. Now they are asking, calculate the annual rate of premium or discount. So what they are asking you over here is that you should be able to give them whether it is at an appreciated rate or whether it is at a depreciated rate. So I'll write down the next working note heading, rate of appreciation or depreciation. So we can find out this for my bid rate also. We can find out this for my ask rate also. So let's start with the bid rate. Everyone tell me what is going to be my spot rate over here, 66.2525. What is going to be my forward rate over here, 66.2640. 66.2640. Am I right? Now, if these are the rates that are given over here, 2640 minus 2525, when you do, you get, wait, we'll take the formula. Now it is rupees per dollar, correct? So when I look at this, I can say that dollar is appreciating, rupee is depreciating. So what will be the rate of appreciation of dollar? It will be 66.2640 minus 66.2525 divided by the average rate. 66.25825, that is for 2.5 months. If I do into 12 by 2.5, I will get for the whole year. So when I do like this, 66.2640 minus 66.2525 divided by 66.25825, you get the answer as 0.01 into 12 divided by 2.5. I'll get the answer over here as 0.0833 percentage plus. So here by default, I'll get the answer as minus 0.0383% because it's the average rate. Denominator is exactly the same. What will be the formula over here? 66.2525 minus 66.2640 whole divided by 66.25825 into 12 divided by 2.5. Correct? So that is the rate of appreciation or depreciation, which is given over here. Everybody clear with this part now? Next one, same way, this is for the bid rate. Same way, I want to go and find out my rate of appreciation or depreciation for ask now. Earlier I did for bid. Now I am doing this for what? I am doing this for my ask rate. Correct? So here again, I'll put the same numbers. Spot. So what is my spot rate? 67.5945. Then what is my forward rate? 67.6083. 6083. All right. So now the formula will be what over here? 67.6083 minus 67.5945 divided by the average rate. 67.6014 into 12 divided by 2.5. Here it will be just the same thing in the opposite manner, correct? 6083 minus you'll get the answer as 0.0979 percentage plus for dollar, and for rupee you will get the same thing as minus 0.0975. I hope you're clear with this part, friends. With this, we are done with this question also. I'll give you 1 minute time. Just read through it, understand the question, after which I will go to the next part. Just one moment, friends. I think I'll create a full screen for you to Yes, friends, please go through this now. I'll give you a minute, just go through this. All right. Then Dakshin, you have a doubt. If we encash now, we will get it into bank, get interest in the bank. Exactly. If you encash now, you can invest, you will get interest over there. Absolutely. That is the logic behind this. Okay. Please go through this now. Sorry, that was the wrong page. Please go through this. Yes, friends. Can I go to the next question now? Are you all clear with this part now? All right. Let me go to the next question now. All right. So we are done with this question also. I hope my audio, videos, everything clear to all of you, friends. If any confusion, let me know. Okay. Next question is on our IRPT. So in IRPT, we have learned that if interest in India and interest in some other country are different, the exchange rate will move in such a way that no person can ever make any profit or any losses. Everybody clear? And there is an equation that we have learned over there. What is the equation? 1 plus RH divided by 1 plus RF is equal to forward divided by spot. Everybody clear? So keeping that in our mind, let's write down question number 3. Working note number 1. Basic data. Are you all ready now? Perfect. Let's start off now, friends. So here I'll write down point number A. So point number A, they have given you the Canadian dollar, that is spot rate is given. So I'll write down spot rate is equal to 0.665 CAD bar DM. And 3 months forward rate is also given. That is again 0.670 CAD bar DM. Are you all clear with this part? Next. Interest rates are 7% per annum. Interest, I'll call it as RH. RH is for CAD because CAD is the numerator. Whatever is the numerator will always be RH. Whatever is the denominator will be RF. That's given as 7%, but 7% is per annum. So I have to convert that into how many months? 3 months. Do I get the answer as 1.7? Hold on. That is DM. I think dollar CAD. This is CAD should be 9%. %2.25%. All right. Then you have RF. RF will be 7% into 3 by 12. So this one is what? This one is CAD. This one is going to be how much? 1.75%, or I will call it as DM. So friends, they have given us all the data. From this data, what they are asking us is to find out what operations would be carried out to get a possible arbitrage gain. So now to get the arbitrage gain, I will write down working note number 2, action for arbitrage gain. So here we'll use the equation. What is the equation? 1 plus RH divided by 1 plus RF is equal to forward divided by spot. So for getting the arbitrage, we will actually go by 4 steps. In this first step would be theoretical home interest rate. All right. So there I'll put 1 plus RH divided by 1 plus 1.75%. That's going to be 1.0175 is equal to forward divided by spot 0.670 divided by 0.665. Everybody clear? So what I'll do 0.670 into 0175 divided by 0.665. I'll get the answer as 1.0251, or that is nothing but 2.51 percentage. Once I get the theoretical home interest rate, I'll compare it with what? With the actual home interest rate. That is, I think, 2.25%. Actual home interest rate is 2.25%. Now everyone tell me, what is the theoretical home interest rate? 2.5. Or the home interest rate should be how much? 2.5. What is the actual home interest rate? 2.25. So in that case, what is happening over here? Can I say actual is cheaper than required? If the actual is cheaper than required, can I say we should borrow at RH or we should borrow at CAD? So the decision that we are going to take over here is that we should borrow at CAD and we should do what? We should invest in DM. Everybody clear with this part now? Borrow at CAD, invest in DM. Now to prove this, I'll create a proof. All right, so there are two countries. You have CAD, you have DM. So what are we going to do over here? I will borrow. Let us say I'm going to borrow 1 lakh CAD. This I'm going to borrow at 2.25 percentage. Therefore, how much money I'm supposed to repay over here? I am supposed to repay 1 lakh 2250 CAD. Correct? This 1 lakh CAD what I borrowed, I will convert at the spot rate of 0.665. 0.665 CAD per day. I'll get the answer as how much? 1,50,375 DM. Correct? Plus 1.75% is the interest in DM. I'll get 1,53,007. Once I get this, I'll be bringing this money back to CAD. At that time, the exchange rate is what? 0.670. Correct? So when I do like this into 0.670, I'll get 1,02,500 CAD, or I'll call it as 515 CAD. This is the money I will receive in my hands. So I repay 1,02,250. I receive 1,02,515. You get the gain over here as how much? 265 CAD. Hence proven that we can create an arbitrage over here by borrowing in CAD, investing in DM. This question is over, friends. Now take 1 minute time, go through the entire thing, after which I will go to the next question. Yes, yes, proof is a part of the answer. Okay. All right, there are some few doubts over here. One doubt is that I'm confused whether to multiply or divide. Yes, there's a very simple way to fix that up. I'll just show you that here itself. Suppose you're doing 50 rupees and you have 10 rupees per dollar. Can you multiply 50 rupees with 10 rupees per dollar? No. What will you do? If you multiply this, you will get rupees square. Correct? You will get 500 rupees square by dollar. So your common sense will only tell you that rupees square doesn't come. So if you don't multiply, what's the other option available with you? You should not multiply, you should divide. Are you clear with this part now? Okay. Next point, Ramdas. RH is always the numerator. So if it is CAD bar DM, always the numerator will be RH and denominator will be RF. Ashwin, you're asking is proof the part of the answer. If the question is coming for 5 marks, no need. If the question is coming for 8 marks, it should be a part of your answer. Shall I go to the next question now, friends? I hope you're all clear with this. Yes, I think we are going in the right flow. I hope you are comfortable with the flow of the class, friends. If you find it difficult, let me know. I will slow down. But I think we can maintain this pace to complete maximum questions also. Okay. Now let us go to question number 4, which is a question on cross rate. So friends, cross rate is basically, for example, if you have rupee bar dollar and then you have dollar bar pound, the moment you multiply, dollar will get cancelled and we'll get rupee bar pound. Okay. That's what we call it as cross rate. Cross rate areas are, something a bit challenging. So always basic data, understanding the question. When it comes to Forex, always give your energy and focus to understanding the question. Everybody clear with this part? Okay. Thank you so much. Thank you, Swati. If you are all comfortable with the class, please do like this video because I think YouTube algorithm always searches based on these likes. I don't want any fake likes. If you genuinely like the class, you like the video also. Okay. Let's go to the next part. Question number 4, cross rate. So question 4, working note number 1, basic data. You sold 100 lakh HKD value spot to your customer. So who are you over here? This means you are the bank. So first thing, I'll draw a diagram. So until we understand the question, we cannot go forward. This is a bank and this is you. You sold 100 lakh value spot to your customer means here he has sold 100 lakh what? HKD. Spot to your customer at what price? At the rate of 5.7 rupees per dollar. Sorry, rupees per HKD. And you covered yourself in the London market on the same day. Now there is something called as covering up of position, which means if you sell to the customer for covering up, what will you do? You will buy. That is the only way you nullify. So what are you going to do over here? You are going to buy 100 lakh HKD value in the London bank. This is your London bank. Everybody clear with this part? On the same day, USD 1 rate is given, USD 1 rupee. So they have given you HKD bar dollar is given and they have given you rupee bar dollar. Now they're asking you to calculate the cover rate and ascertain the profit or loss. So basically here, I will need some rate of rupee bar HKD. But in this question, unfortunately, they have not given any rupee bar HKD rate. They have only given you rupee bar dollar and they have given you HKD bar dollar. Now think and tell me, friends, rupee bar dollar is given, HKD bar dollar is given. From these two things, is it possible to find out rupee bar HKD? Yes, it is possible using a concept called as the cross rate. So I'll just go to the next page now. Working note number 2, cross rate. So to get the cross rate, we have to go by 4 steps. Step number 1 is what I call it as the desired rate. So in my example, what is the desired rate? I want rupee bar HKD. Step number 2, I will try to find out whether it is going to be a bid rate or whether it is going to be an ask rate. So if it is going to be a bid or ask, I can decide based on the diagram that I always draw. Okay. Now, Based on this diagram, what we will do is, I basically want to do what? I am the bank. I want to buy 100 lakh HKD. I want to buy HKD. In return, what will the bank do? Sell rupee. Sorry, here I think the diagram I need to correct. It's not a person here. It should be a bank over here. This is you. This is the London bank. So what will the London bank do in return? Sell HKD. What will I do? Buy rupee. And here I'll write down rupee bar HKD. So this is HKD. Sell HKD. So when I do sell HKD, what is the thing that I'll get? It will be the ask rate. Am I right? So I got to know it is the ask rate. Then I will go to step number 3, where I will give a heading called as cross rate. So how do I create a cross rate now? I want ask rupee bar HKD. In the question they have given you, ask rupee bar dollar is given, ask dollar bar HKD is given. Correct? So if I multiply these two, I can get ask rupee bar HKD. Shreyas, very, very good. So the equation over here will be ask rupee bar dollar into ask dollar bar HKD. Okay. So when I do it like this, dollar will get nullified. So now tell me how much is the ask rupee bar dollar? Ask rupee bar dollar 42.85 into ask dollar bar HKD. Friends, they don't have dollar bar HKD, they have only HKD bar dollar. Now tell me, friends, how do you convert HKD bar dollar into dollar bar HKD? You will do 1 divided by interchange. So you'll first do 1 divided by and interchange the bid and ask. So here ask will become bid will become ask. So it will be 1 divided by bid 7.588. Bid, that is not 7.588. Okay, so when I do like this, I'll get the answer as 5.647 rupee bar HKD. 5.647 rupee bar HKD. I hope everybody is clear with this part now. Okay, so once you get this answer, I'll go back to the diagram. 5.647 rupee bar HKD. That is nothing but 564.70 lakhs. So when I look at the diagram, here it's actually turning out to be 570 lakhs. 100 lakh into 5.7. 570 I sell, I buy back for 564. So as you said, I'll get the answer as 5.3 lakh rupees. Okay, so this is the gain, and this question gets over. Take 2 minutes, go through this question on your own. Yes, friends, I believe you're all clear with this part. Can I go to the next question now? So question number 4 is also over. Okay. So sometimes do we need to take decision based on currency premium? Currency premium. Not sure what you're asking me, Gokul Krishnan. If you can send some image in my WhatsApp, I'll definitely check and get back to you. Yes, friends, any of you, anytime you have a doubt, you can always WhatsApp me on this number. I normally reply within 2 days, but now since the exam is near, I will definitely give a reply tomorrow itself. Okay. This is my number, just note it down. All right. Yes. So now let's go to the next question. Question number 5 is a very lengthy question. You have bank A, bank B. This question, one of the peculiarities that we need to understand over here is that here they have given you as USD bar CHF. You need to understand that USD bar CHF 1.4650/55. How do you interpret this? This is actually nothing but 1.4650 hyphen 1.4655 CHF bar dollar. That is how you interpret this. Okay. So basically, why are we interpreting like that? You have to understand that here they have written USD bar. This has to be read together. So it's basically CHF 1.4650, CHF 1.4655 for every $1. Okay. This is an industry practice. Don't get confused. If you read any question like USD bar, INR 50, these are written together, correct? There is no gap or hyphen in between. It has to be read the other way. Sometimes they'll give you like INR bar USD hyphen 50. That means what? It is 50 rupees per dollar. Okay, you need to understand the difference. USD bar INR 50 can be given, or they'll give you as INR bar USD hyphen 50. So this is read together. That means rupee per dollar is 50. Here 50 rupees is $1. I hope you're understanding what I'm trying to tell. You should know how to read this together. Here you're supposed to read this part together because they have a hyphen over here. Everybody clear with this part? So in this question, one of the thing is they have given you bank A, bank B. They have given you the spot rate. 3 month swap points are given. 6 month swap points are given. So everyone interact with me. If swap points are in ascending order, do you add or do you subtract? You will add. If so, here is it in ascending order or descending order? It is in ascending order. So what will you do? Will you add or will you subtract? You will add. Down, they have given GBP slash USD 1.7645. What does that mean? 1.7645 dollar bar GBP. Okay, don't get confused. It's dollar bar GBP. Now here the swap points are 25.20, 35.25. Correct? So 25.20 means are they in ascending order or descending order? They are in descending order. Will you add or will you subtract? You will subtract. So friends, part 1 being mechanical step, I'm not writing in the book. They have done the addition. So they have put the bid rate, ask rate. Swap points are in ascending order. So they have done add. Here also they have done add. Okay, this is bank A. Same thing they have done for bank B now. Bank A, wait 1 minute. Bank B, same thing they have done. Spot, 3 month swap, forward, 6 months forward. Forward, spot, 3 month swap. These are descending orders or subtracted. Okay. This is also subtracted. So like that, we basically in this 4 tables, even though there is a lot of calculation, what we are doing here is we are only trying to find out the forward rate over here. Everybody clear? So in the forward rate, we are getting the answer as, whatever is the answer. Spot we got the 3 months forward. We also have the 6 months forward. Once we get that, then we start solving the question. So far, even though these calculations are very long, it would take you maybe 20-25 minutes to do all these things. But question solving starts only after this. So you have only done the basic data and the analysis so far. Everybody clear? Now let us read the question. So the question that they have given over here is how much minimum CHF amount you have to pay for 1 million GBP spot. So I'll write down working note number 3. 1 was basic data, 2 was analysis. Now, minimum CHF required for $1 million GBP spot. Okay, so now When you go for this one, okay, so here I'll just write down, you need minimum CHF and you need 1 million GBP spot. First, I will draw the diagram to know whether it is bid rate or ask rate. Okay. So now what is happening over here, or maybe I'll go by the cross rate steps, because if you need CHF to buy 1 million GBP by default means what? It means the desired rate. I'll put step number 1. Your desired rate will be CHF bar pound. GBP is nothing but pound. Everybody clear? Once you get the desired rate, step number 2 is whether it is going to be a bid rate or whether it is going to be the ask rate. Now, minimum CHF required for 1 million GBP spot means I need to buy GBP. In return, I need to sell CHF. Am I right? The commodity is, the exchange rate is what? CHF bar pound. Pound is the commodity. Sell. So what rate is applicable over here? It is going to be the ask rate. Everybody clear with this part? So once you know that it is the ask rate, then I will go for step number 3. What is step number 3 over here? It is the cross rate. Okay. So now when you go for the cross rate, here the equation will be ask CHF bar pound is equal to ask. They have two things over here. They have CHF bar dollar and they have dollar bar pound. Now is the question, they want minimum CHF. So when you want minimum CHF, first thing it is spot. So I can get the data from the table here itself. Ask CHF bar dollar 1.4655 in bank A, 1.4660 in bank B. Listen, they are asking for minimum CHF. Bank A 1.4655, bank B 1.4660. So when you have 1.4655 here, 1.4660 there, which is minimum 1.4655. Okay. Now ask dollar bar pound. Ask dollar bar pound 1.7660, 1.7650. So which is minimum 1.7650. Do I get the answer as 2.5866? Everybody clear with this part? So this I got from bank A, this I got from bank B. Some of you will be thinking, is it possible to multiply bank A into bank B? The answer is no. You cannot multiply like that. But I can first take CHF, go to bank A, give CHF, get dollar. Take the dollar, go to bank B, give dollar, get pound. Very simple, common sense approach. We can always do it like that. Okay. So once you get 2.5866, so the minimum CHF would be 1 million means 10 lakh pound. 2.5866 CHF bar pound. Alright. So you'll get the answer as 10 into 2.5866. I'll get the answer as 25.866 lakh CHF. Everybody clear with this part? Okay. Devika, you want me to re-explain this part? See, when I'm talking about minimum CHF, what I'll do is, I understood that bank A has minimum CHF bar dollar and bank B has minimum dollar bar pound. So now what I'll do, I'll take 10 million pound first, then I'll go to bank A first, where there the rate is 1.4655. I'll give the pound and I'll give the CHF. I'll go with 25.86 lakhs of CHF to bank A, give it over there, convert that into dollar. Okay, so that will be 25.866 divided by 1.4655. I will get 17.65 lakh dollar. After taking this dollar, I'll go to bank B. I'll give 17.65 lakh dollar there at 1.7650. They will give me 10 lakh pound. Like that, I will convert. I hope you are clear with this part now, friends. Okay. So like that, you get the minimum CHF amount as how much? 25.866 lakh CHF. Part 1 is over. This question is very lengthy. So what I'll do is I'll give you 1 minute cool off time. Go through this. If you have any doubts, you can ask me. All right. So I believe you're all clear with this part, friends. Okay, I'll go to the second one now. Second question is considering the code from Bank A only. So now let's forget about Bank B. We'll talk only about Bank A. In Bank A, for GBP slash CHF, that means CHF bar pound, what are the implied swap points for spot over 3 months? So how do you find out swap points? Forward minus spot. Am I right? So I'll just write down next working note. Implied swap points for CHF bar pound. Here I'll write down particulars. I'll write down particulars. You have bid rate, then you have ask rate. All right. Then I'll write over here spot, forward, and from this I'll get the swap. Right. So for CHF bar dollar means in the question, have they directly given CHF bar pound? No, they have given you CHF bar dollar and then they have given you dollar bar pound. From this, they want you to find out what? They want you to find out the swap points. So step number one, what will happen over here is, I'll just write down step one. I need to find out the spot CHF bar pound bid rate. So like this, actually I have four combinations. Spot bid combination 1, spot ask combination 2, forward bid combination 3, forward ask combination number 4. So first one, the equation will be spot bid CHF bar pound will be equal to spot bid CHF bar dollar into what? Into spot bid dollar bar pound. Is everybody clear with this part? So now when you put it in this angle, I'll just go to the next one and explain. Okay, that spot bid CHF bar dollar is how much? Spot bid CHF bar dollar is 1.4650 into spot bid dollar bar pound. Spot bid dollar bar pound is going to be 1.7645. Okay. You get the answer as 2.58499. 2.58499. Like this, we have to find out spot ask, forward bid, forward ask. So what will be the formula for spot ask? Spot ask CHF bar pound will be equal to spot ask CHF bar dollar into spot ask dollar bar pound. Same thing, but it will be for spot ask. So like that, friends, the routine calculation I'm not working out. Instead, I'll just show you the solution over here. Spot bid CHF bar dollar into spot bid dollar bar pound. You got 2.5849. Spot ask CHF bar dollar into spot ask dollar bar pound. You will get 2.5881. 3 months forward bid CHF bar dollar into 3 months bid dollar bar pound will get 2.5822, 2.5869. When you solve this, you get the answer as 2712. With this, we are done with this question. So take 1 more minute, friends. Go through this entire thing. Okay. And after you're thoroughly clear with this, I will go to the next question. Yes, friends, I hope you are clear with this part. Can we go to the next question now? We have one more question on cross rate being a very good area. We have done a lot of questions on that. Let us do question number 6 now. Question number 6. Working note number 1. Basic data. All right. Your Forex dealer. So when they say your Forex dealer, it means it is you only and you're the bank. Or I'll write down your Forex dealer means he is doing it on behalf of you. Your Forex dealer means he is doing it on behalf of you. All right. Has entered into a cross currency deal and has sold 10 lakh dollar against euro 1.44 per dollar. This question actually has a mistake because euro is actually more powerful than dollar, but here they are showing it as dollar being more powerful than euro. That's a one-time mistake. Normally, Institute doesn't bring up questions like this. This is a one-time rare scenario, but since it's there, I would thought I will do it. So what is the current position? Sell 10 lakh dollar at the rate of 1.440 euro per dollar for spot delivery. However, so initially what has they done? Sell 10 lakh dollar. So when you sell 10 lakh dollar, what is the amount you get? Do I get the answer as 14 lakh 40,000 euro? Correct. Now they are saying, however, later the market became volatile and the dealer, in compliance with his management guidelines, had to square up the position. So, how do you square up the position? If your original action is sell, to square up, what will you do? You will buy. You're going to buy 10 lakh dollar at the rate of, when you buy dollar, the bank is going to sell dollar. Correct? Dollar is the commodity over here. It will be the ask rate. Euro per dollar is available. Ask rate is 1.4450 euro per dollar. So I think you get the answer as 14 lakh 45,000 euro. Correct. So that means, are you making a loss or are you making a gain over here in this transaction? You make a loss in euros. And what is the loss in euros you're making over here? You make a loss of 5,000 euros. Friends, in this question, they have told it is a cross currency deal. So when they say it's a cross currency deal, the definition of a cross currency deal is that there are in total 3 currencies. Out of these 3 currencies, 2 will be foreign currency, 1 will be home currency. So in this question, euro foreign currency, dollar foreign currency, rupee home currency. Are you all clear with this part? So initially the gain or loss will happen in the foreign currency. Here you made a loss of 5,000 euro in the foreign currency. And once you make the loss, in order to cover up for this loss, whatever you do, you convert that in the home currency. So now if I want to cover up or pay this loss, I will have to get the spot rupee bar euro rate. Then only what can I do? Then only I can go and find out what is going to be my loss in rupee. Everybody clear with this part? So now in this question, have they directly given rupee bar euro? No, they have only given rupee bar dollar and euro bar dollar. So now tell me, if directly it is not given, how do you find this out indirectly? You do it by using the cross rate. So what are the 4 steps involved in the cross rate? Desired rate, bid or ask, cross rate and equation. So I'll go to the next page now and I'll write down step number 1. Desired rate. So what is the desired rate? Rupee bar euro. What is step number 2? Bid or ask. So what will you do over here? Sell euro. Sorry, you need to pay. There is a loss, right? So you have to buy euro from the bank so that you can pay the person. So you will give rupee to the bank to get euro so that you can settle the loss, correct? Buy rupee, sell euro. Rupee bar, euro. So what is the commodity over here? Euro. What is it? Sell euro. So what rate is applicable over here? It is the ask rate. Are you all clear with this part? So once you get this as the ask rate, then I will go to step number 3. What is step number 3? It will be the cross rate. So in the cross rate, what will happen? It will be ask rupee bar euro is equal to ask ask rupee bar dollar into what? Ask dollar bar euro. Am I right? So now tell me, what is ask rupee bar dollar that you have over here? Ask rupee bar dollar is given as, wait, rupee bar dollar is 31.45 into ask dollar bar euro. They have given euro bar dollar. How do you convert euro bar dollar into dollar bar euro? It will be 1 divided by interchange. So how will you do that? 1 divided by bid. So 1 divided by 1.44. So you'll get the answer as 21.84 rupees per dollar. Okay, so once you get 121.84, I will write the conclusion. So what was the loss in euros that I had? 5,000 euro into 21.84 rupee bar euro. When you do, you'll get the answer as 1,09,200. 200 rupees. This is going to be my loss in rupee, and with this question will get over. Can you please write down this in your books or just scribble and write and understand this? I'll give you 1 to 2 minutes of time. Iron, this ask rate has come because there is a loss. So when there is a loss of 5,000 euro, I should pay that 5,000 euro. If I need to pay, first I should have euro with me. How will I get euro? When I go to the bank, I will buy euro. So I go to the bank, I buy euro. Now after buying euro, what am I going to do? I'm going to go and give it to the person. So when I buy euro, what is the bank doing? Sell euro. Hence it is the ask rate. Okay. All right, friends, shall we now presume continue now? Wait, there are some doubts over here. So, what if it was a gain? Shilpa, in a cross currency deal, even if it's a gain, you get the gain. Nothing to worry over there. Okay. Now, Rashmi, you're asking which line in the question indicates desired rate. See, it doesn't indicate. What happens is when you made the loss, they have used the word cross currency deal. Correct? So, when they use the word cross currency deal, it means there are going to be three currencies. Two will be foreign, one will be home. Initial transaction will be in the foreign currency. Final gain or loss has to be in what? In the home currency. So if you want to convert this into the home currency, you need this rate. Is this rate available? No. So you have to go by the cross rate. Shreyas, when you want commodity, you use ask rate. When you want currency, you use bid rate. No, Shreyas. Whatever is the commodity, if you buy the commodity, if the bank is buying the commodity, it is bid rate. If the bank is selling the commodity, it is the ask rate. Perfect. Thank you, Harsh. Thank you so much. I believe we are done with this question also, friends. Can I go to the next question now? We are done with cross rates also. Now we come to forward contract. Forward contract is a contract entered today to be executed on a future date. In forward contract, you have cancellation of forward contract, you have extension of forward contract, and then you have execution of forward contract also. So let us do this question number 7 now. Working note number 1, basic data. Let us understand the question. Customer with whom the bank has entered into a 3 months forward purchase contract. If the bank has entered into a purchase contract, from the customer point of view, it will be a sale contract. Am I right? So I'm going to draw a diagram from the customer point of view. Yes, so from a customer point of view, it's a sale contract. So here, let me go and check. 3 months forward purchase contract for Swiss franc 10,000. So I'll write sell 10,000 Swiss franc at the rate of 27.25. That will turn out to be how much? 2,72,500. This is today, or I'll call it as T0. Okay. Now what is happening? He comes to the bank after 2 months. It's a 3 months forward contract. So it should actually be executed on what date? On this date. So this was supposed to get over on this date. But now this fellow has come to the bank after how many months? He has come to the bank after 2 months. So why has he come to the bank after 2 months? So that he can cancel the contract. Now tell me, how do you cancel this contract? You will have to buy 10,000 Swiss francs. How many months forward? 1 month forward, because other one is 3 months. Now after 2 months you enter into a 1 month forward contract. So 1 month forward, will it be bid rate or ask rate? I am buying Swiss franc. What is the bank doing? Bank is selling Swiss franc. So if I am buying Swiss franc and if the bank is selling Swiss franc, it will be the bank being selling the commodity. It is the ask rate. So what is the 1 month forward ask rate that is given over here? 27.52. That will be equal to 2,75,200. It will get nullified. Okay, so now when you do this, here you get 2,72,500, 2,75,200. So when you take the difference between this, you get the loss of how much over here? 2,700. With this, even this question gets over. Take 1 minute, go through this question. Yes, friends, are you all done with this part now? Can I go to the next question? Okay, so we are done with question number 7 also. Let us go to question number 8. 8 is a question on extension of forward contract. Okay, that is question number 8. So I'll write down over here question number 8. Working note number 1. Basic data. An importer requested his bank to extend the forward contract for $20,000, which is due for maturity on 30/10/2010. Ashwin, yes, that's more than enough. That question came for 6 marks. It's more about the conceptual clarity also, Ashwin. Understand that. That if you're conceptually clear, only then you can work it out, right? So it's more about the conceptual clarity there. So extend the forward contract for $20,000, which is due for maturity on 30/10/2010. So, okay. Importer. Friends, as an importer, what will he normally do? He has to make payment for the dollar. If he needs to make payment for the dollar, will he buy dollar or sell dollar? He will buy dollar. So it is going to be over here, buy $20,000 at the rate of 42.32. Okay, so what is 20,000 into 42.32? Do I get the answer as 8 lakh 46,400 over here? Am I right? This is done at some previous date. Which date they have not told. So now this buy of $20,000 at 42.32 is done right now. It's supposed to be extended for a further period of how many months? For a further period of 3 months. So on this date, he wants to extend the contract. How will you extend it? First, you have to cancel this, and then only you can extend it for another 3 months. How do you cancel it? You will sell $20,000 at the spot cancellation rate. So what is the spot cancellation rate over here that you have? Sell $20,000 at the spot bid rate. What is the spot bid rate? 41.5. Correct? Wait, I'll go to that part later. After you sell, that is step number 1. Next, what will you have to do? You will have to buy the same $20,000. How many months forward now? 3 months forward. So here I have to do it at the spot cancellation rate. Only once I do these 3 steps, I will be able to cancel the contract. Everybody clear? So this is the action plan which I am supposed to use in order to cancel this contract and extend it for a further period of how many months, friends? Extend it for a further period of 3 months. But the challenge that lies over here is that they have given you the spot rate, they have given you the 3 months premium over here, and they have given you the margin for buying and selling. So when I say margin, it is the banker's commission. So banker, if he is buying the commodity, he is charging 0.075% commission. Banker, if he is selling the commodity, he is charging a commission of 0.2%. Everybody clear? So what he does is, if he is buying a dollar, in this case it's dollar, the moment he buys dollar, he will pay rupee. But while paying rupee, he will reduce the 0.075% commission, and only the balance money is what he will pay outside. Same way, if he is selling dollar, he will receive money from the customer. So when he receives money from the customer, he will add 0.2% extra and he will collect it from the customer. Did you understand that part? So even before I continue solving this problem using this diagram, I should go and find out what is my spot rate after commission and what is my forward rate after commission. For forward rate, he has told there is a 3 months premium, 0.87%, 0.93%. This premium is in ascending order or descending order? It is in ascending order. So what will you do? Will you add or will you subtract? You will add. Are you all clear with this part now? I'll just come down. I'll show you the table first. This is how you get the forward rate. Spot rate is given. 3 months premium is given. So you get the 3 months forward rate. From that you do an adjustment for margin and you get the 3 months forward rate after margin. Take 1 minute, just read through this part so that you are clear with how they have worked out the forward rate. Same way you need to work out the spot rate also. How do you work out the spot rate? Directly take these numbers and you can reduce the commission, and over here you can add the commission. Okay. Take a minute, go through this. Friends, I hope the audio is very much clear to all of you. Yeah. All right. I believe you are clear with this. Okay. So the forward rate part is clear over here. And I think now same way, we have to just go and find out the numbers right now. Correct? Okay. So now we'll just read through this part. Here they are doing it. What is the current position? Buy $20,000 at 42.32. Let's correlate. Buy $20,000 at 42.32. Okay. 8,46,400. 8,46. Okay, I think there's a small typing error over here. 20,000 into 42.32. Yes, it's just a typing error, friends. I'll just correct that part. It should be 8,46,400. Okay, that's the first part. Now I told you what is the action for cancelling. I told you sell at the spot cancellation rate. So you will sell $20,000 at 41.46. How did they get 41.46? Let's go and check. It was actually bid rate. It's 41.50, correct? So what is 41.50 minus 0.075 percentage commission? That will give you 41.46. It's after adjusting the margin money. So you get 41.46. Are you all clear with this part? So when you take the cancellation action, you get 8,29,400. So when you do this, you get a loss of 17,000. Is this loss real or imaginary? It is a real loss. After you make the loss, you have to extend the contract. How do you extend the contract? You buy $20,000. How many months forward? 3 months forward. Okay. So here you buy $20,000. 3 months forward. Ask rate, that is 41.99. How do you get 41.99? You got from here. Okay. So you got from here. So you get the number as 8,39,860 and you get the final number as 8,56,860. Okay. I'll give you a minute. Read through this entire thing. First, I think you read through the diagram. That diagram and understand the diagram. After that, I'll show you this page. Read both properly and take it forward. Indra, I'll explain the margin part again. Listen carefully, Indra. If you buyer's commission is that when the bank buys dollar, bank will reduce commission and pay the balance money to you. Suppose Indra, you go to a foreign exchange dealer. You have $1 with you. You give the $1. They are supposed to give you, let's say, 80 rupees per dollar. Instead of giving 80 rupees, they will reduce 1 rupee as their commission and they will pay you only 79 rupees. Option 2, you are going there to buy dollar. Now when they are giving you the dollar, they will give you the dollar at 80 rupees plus they will add 1 rupee commission. So they will charge 81 rupees from you. That is why when the bank is buying dollar, they reduce the commission and pay you the balance. When the bank is selling dollar, they will add the commission and pay you the money. Okay. Now take 1 minute time. First understand the diagram, then understand the solution with this you're through. Okay. Yes, friends. So let's go to the next question now. I hope you are clear with this one. Okay. Question 9 is on futures. Friends, futures are similar to forward contract, but there are three differences. Difference number one, futures are dealt in contracts. Difference number two, futures are having margin deposit. All right. And difference number three, futures are standardized and you can see that in money control. Forwards can be anything. Like you can say that I'm going to write the exam tomorrow. Even that is a forward contract. Are you clear with this part? So when you come to future, there can be two scenarios in Forex. Scenario number one, you have a future receivable. Scenario number two, you have a future payable. Okay. So if you have a future receivable, you go by four steps. Step number one, number of contracts. Step number two, sell future. Step number three, buy future. Step number four, sell spot. If you have a future payable, you will have four steps. Number of contracts, buy future, sell future, buy spot. Are you all clear with this part? Okay. Now, Harsh, I have a doubt over here. How do we understand at first the place becomes customer bought 2 lakh dollar or $20,000? Let's check. Okay. So that is the first part, Harsh. A very good question that you have asked me here. An importer is requesting the bank. So as an importer, Harsh, if you are an importer, that means you have to pay money. If you have to pay money, first you have to go to the bank and buy dollar, then only you can pay money. That is how we presume that, it is going to be a buy dollar scenario. One assumption that we have over here is that we are in India. That one assumption they are taking. Ideally, we should not think like that. But when the question is silent, we have no other option but to assume that we are in India because you're writing the exam in India for ICAI, which is an institute which is located in India. Are you clear with this part now? All right. So I think you're clear with part one. Okay, let me just come down. Okay, so now we'll do a question on futures. This is a simple question. Question number 9. Working note number 1, basic data. Basic data. All right. X Limited has to receive $4 lakh after 3 months. So here, what is the receivable that you have? 4 lakh dollar. That is your receivable, correct? Your duration of how many months over here? Duration is going to be 3 months. All right. Now down they have told the contract is $1,000 per contract. So from this, can I go and find out the number of contracts? Number of contracts will be 400. How did I get this 400? It will be A divided by C. Total receivable is $4 lakh and it is $1,000 per contract. So you get number of contracts as 400 contract. Friends, in my class, I kept on telling the number of contract is more of a showpiece item. Okay. Find out, keep it there. Don't use it any further in the examination. Everyone clear? Okay. Okay, next one. I'll write down point number E. They have given you the spot rate. So the spot rate is what I call it as S0. S0 is 44 rupees per dollar. Then you have S1. S1 is 45 rupees per dollar. Then you will have F0. 44.5. F0 is nothing but contract entered today to be executed on a future date. And they have given you F1 over here, which is 44.5 again. In my classes, I have told friends, S1 and F1 normally will be the same because S1 is the spot rate on expiry. F1 is the future cancellation rate on expiry. So they both are normally the same. Little deviation might come, but normally it's going to be the same. Now, since you have a receivable, we'll go by 4 steps. What is step number 1? Number of contracts. So here, what is the number of contracts that we got? 400. What will be step number 2 now? It will be sell futures. Now, when you're talking about sell future, what will you do? $4 lakh divided by, so initially you sell future at F0. $4 lakh into 45. I think I've made a small mistake here. Your F0 is 45. I've written it wrong. These two are the same. Your F0 is 45. So So I think 4 lakh into 45 would give you the answer as 180 lakhs. After this, for cancelling the contract, what will you do? Sell future, buy future. But now you will buy at what price? You will buy at F1. So when you buy at F1 means you will buy 4 lakh dollar into 44.5. So I think you will get the answer as 178 lakhs. So when you do like this, you make a gain or you make a loss. You're going to make a gain. The gain will be how much? It will be the 2 lakh rupees. Everybody clear with this part? Okay. So gain will be 2 lakh rupees. And after this, what will you do? You will sell spot. So you sell spot again at what price? 44.5. So you get the answer as 178 lakh. So once you do this, you get the total final answer over here as how much? 180 lakh rupees. This will be the amount that you will receive under the future contract. All right. Now take 1 minute, go through this, after which we will go to the next question. Yes, friends, can we now go to the not last, the next question? Next question is a beautiful question. Are you all ready for it, friends? I hope you're all not tired. I know you would have had a very heavy day with FR and now with AFM. But let's finish off this chapter, friends. Okay, please support me. So once we are done with this, you will be also much relaxed and you can always plan for, the other chapters tomorrow. Okay. So question number 10, beautiful question. Working note number 1, basic data. Okay. X is an export oriented company. It invoices the customers in the customer's currency. It will receive $1 lakh. So first data that we need over here is our receivable, which is equal to $1 lakh. Okay. After this. Swapna, sorry, no. 2 minutes. You want a break of 2 minutes? Is that what you meant? Your name is coming as no name. I don't know what name to call you. Okay, shall we continue? I think I have retracted the message. Let's continue. Okay. So receivable $1 lakh. Okay. After how many months? After 3 months. After 3 months. Now they have told, okay, they have given you the spot rate, that is S0, 0.02140 dollar bar rupee. Friends, are you feeling uncomfortable seeing dollar bar rupee? No. Dollar bar rupee can also come in the exam. Then they have given you the 3 months forward. So I'll write down 3 months. Forward rate is 0.02127 dollar bar rupee. Okay. Then they have given you the contract size. Contract size. That is 4,72,000 rupees. After this, they have given you the futures for June, for September. What is relevant to us? For June, for September is relevant. So I'll call that as F0. F0 is the contract entered today to be executed in September. After I write down this, I'll write down point number G. So F0 is done. Okay. Then they have told the margin for September. Margin for September 15,000 per contract. It is 15,000 per contract. All right. And they have told the interest on that date is 8% per annum. 8% per annum. On September 1, 2005, the spot rate is 0.02133 dollar per rupee. So S1 is also given. 133 dollar bar rupee. And the currency future rate. And the currency future rate is going to be 0.02134 dollar bar rupee. So I think we have put all the data over here. Receivable, duration, forward rate, no hedging rate, everything is put over here. Once we are done with the basic data, they are asking you for three options over here. First one, forward, future, no hedging. So what I'll do is I'll start with forward, then I'll go for no hedging, and then I'll go for future. Okay. So I'll write down first forward contract. So for forward contract, we already have the forward rate given in the question. So it's very simple. $1 lakh, 0.02, sorry, 0.02127. You get the answer as 47 lakh 1,457 rupees. Okay. Once you get this, I'll write down working note number 3, no hedging. Okay, so here I'll write down $1 lakh divided by 0.02134, I think. Yes, no, that's 133. 133 dollar bar rupee. I'll get the number as 46 lakh 88,233 rupees. Are you all clear with this part now, friends? Yeah. So basically, three options: forward easy, no hedging easy. Next, I will do future. So before that, I'm giving you a 1 minute cool off time. Go through these two sheets. If you're clear with this, then we'll start and we will do the future contract together. All right. Yes, friends. Hold on. I hope you all can see me. Yes. I think everything is comfortable. Right. Shall I continue now? All right, friends. I think we can continue now. So I'm going to the last part now, futures. So, friends, in futures, the last part in futures, first thing that we have is number of contracts. Number of contracts. So to get the number of contracts, first I will write down what is my dollar receivable. That is 1 lakh dollar. What is the future rate that is available over there? F0 is how much? The future rate was 0.02118. 0.02118 dollar bar rupee. So when I divide with this, I'll get the number as 47 lakh 21,435 is my rupee receivable. Correct? Now, once I get this, I have a contract size. So what is my contract size? 4,72,000 rupees. From this, can I go and find out what will be my number of contracts? So this divided by 4,72,000 will give you the answer as 10.0030409 contracts. Everybody clear with this part? Normally, I tell you, you can put 2 decimals or 3 decimals. But in this question, I will tell you, don't round off. Because this contracts is what will help you to determine how much of the number you will be in the future, how much will be no hedging. So what happens over here is, out of 10.0030409 contract, you will enter some contracts in future. The balance contract will either go to forward or it will go to no hedging. So I would take no hedging in this question. In one other question, I will do it using forward. All right. So now, when you're putting it this way, this chart will have 3 layers. The 3 layers will be, one will be the contract and other two will be the currency commodity. Currency and the commodity. 0.0030409. Next one is the currency. What is the currency? Dollar bar rupee. So we'll take dollar. How many dollars are there over here? 1 lakh, correct? So 1 lakh I'll divide it by 10.0030409 to get the number of contracts into 10. So you get the answer as $99,969.6. And the balance of $30.40 will come over here. After currency, we will take the commodity. What is the commodity? That is rupees. So total rupees is 47 lakh 21,435 divided by 10.0030409 into 10 contracts. So I'll get the number over here as 47 lakh 20,000. Then here you will get the number as 1,435. Okay, take 30 seconds. Understand this, because once the contract is split, then the remaining part becomes easier. I'm going a little slow on this question because it's a little tricky problem, friends. Once this question is done, the easy ones, we can do it faster. Fine, friends. I believe you're clear with the first part. Can I go to the second part now? Once the contract part, yeah. Indra, you want the calculation for 99,969? That is nothing but total how many dollars was actually there over here. You had 1 lakh dollar. This is for this many number of contracts. But I cannot enter into this number of contracts. I can only enter into 10 contracts. So I will apportion this 1 lakh in the ratio of 10 is to 0.0030409. That is how I get this answer. So out of the 1 lakh dollar, this much will go under future. Balance will not go under future. It will only go under what? It will go under no hedging. Are you clear? Same way, total 47 lakh 21,435 I should have got. But now I will get only this much over here. Balance will go under no hedging. Are you clear now, Indra? Okay. Yes. So once I do this, then I will go to the next part where I am going to do what? I will be selling future, buying future, selling spot. So when I sell future at what? I will sell it at F0. So $99,969.60 divided by 0.02118. Then you will get the number as how much? 47 lakh 20,000. Okay. Once you do this, then I will go for the next step, that is buy future. So when you go for buy future, here what will happen? 99,969.6 divided by F1. So what is the F1 that you are having? F1 was 0.02134, correct? Yes, 0.02134. 46 lakhs 84,611. All right. So I did sell future, then I did buy future. After this, what can I do? I will just do sell spot. I'll do sell spot. So when I sell spot, now I'm selling in the real market. In real market, I'm having full 1 lakh dollar divided by 0.02133. That is going to be 46 lakhs 88,232. Okay. So once I do this, I will take what is my net receipt so far. Now margin deposit is yet to come, but let's just find that out. Okay. So when I do this buy and sell, I'll make a gain or a loss. So here I think I've made a gain. The gain will be 4684,611, 35,389. Okay. So 35,389 plus 4688,232. That is 47 lakh 23,621. Now, friends, what happens is after this, we have a step called as opportunity cost. So, what do you mean by the word opportunity cost? Opportunity cost means now I have made a profit, but I have to put margin deposit. They have told the margin deposit is 15,000 per contract. Like that, how many contracts I have to enter into? 10 contracts, correct? So 15,000 into 10 will give you how much? 1 lakh. 1 lakh 50. So basically 15,000 into 10 is 1 lakh 50. On this 1 lakh 50, I am supposed to pay an interest of 8%, correct? For 3 months. So I end up paying an interest of 3,000 rupees because I would have got this interest earlier. Now, because I entered into future, I withdrew that money from my FD. Now I will not get this interest. That becomes my opportunity cost. So after this, my final receipt under future will be 47. Basically, it will be 47 lakh 23 minus 3,000. So that will be nothing but 47 lakh 20,621. And this is the amount I will receive under which contract? Under the futures contract. Can you take 1 more minute and just go through this entire thing, friends? Yes, friends. So we are done with this question also. Do you want a short break, friends? 5 minutes of cool off time. Do you want? Or shall I go to the next question? You tell me accordingly, we can do it. Next one is money market hedging. Now we have mainly money market hedging is there, transaction exposure, Nostro, Vostro. These are the three major parts that is conceptually left to be covered. Then we have repeated questions on these areas. We'll see if we get time, we'll do that. Okay. One question of London is there, London, New York, Frankfurt, that I want to work out. Then any such tricky, extreme tricky questions, we'll work it out. All right. Okay. No name. Can you please keep a name for yourself? You want a 5 minutes break? Others, please give me your opinion also. Accordingly, we will, take that break. I think we'll take a short 5 minutes break. Okay. Receivable, sell, buy, sell. If it was payable, exactly harsh. If it was payable, it would be buy, sell, buy. Are you clear now? So let's. I'm not shutting down my this thing, my laptop or my YouTube live. 5 minutes break. Time is 9:58 p.m. in my phone. I don't know what's the time in your phone. 10:05 p.m. We'll resume back with money market hedging. Okay. See you after the break, friends. Thank you. Friends, I'm back. Sorry, I became a little late. Are you all there? Sorry, I didn't go to watch that IPO power play. I just went down to have a cup of tea. Sorry, it became a little late when I went to take my tea. Sorry for that. Shall we continue now? All right, friends, let's continue now. I hope you enjoyed the power play. Just tell me what is happening there. Who's playing today? Right. So let's start off now with money market hedging. Okay. I'll just write money market hedge. So friends, when you have money market hedge, you have two things. One, you have money market hedging in case of receivable, or you have money market hedging in case of payable. So what happens is, in case of receivable, okay, there are certain steps. Payable, there are certain different steps. So we have covered two examination questions, one for receivable and the other one is for payable. All right. So can we start off now with that? Okay, let's continue now. So here in this question, question number 11, I'll write question number 11, working note number one, basic data. Okay. So in basic data, they have told that they have a receivable of 3 lakh 50. I'll just put a diagram. You have UK here and you have US over here. So in UK, you have a receivable. Okay, tell me, friends, receivable is what? Is it a asset or is it a liability? Receivable is an asset. So if you have an asset, correspondingly, what will you do? You will create a liability. Okay, how will you create a liability over here? You'll create a liability by borrowing in dollar. Correct? You will borrow some money which along with the interest rate in dollar. So here the interest rate in dollar, borrowing loan rate in dollar is 9%. 9 into 3 by 12 is 2.25%. So with 2.25% should ultimately end up to be $350,000. Okay. So you create a liability. Now if you do a reverse working, what will be the value of X? Can we just work it out? Do you get the answer as 3,42,298? Am I right? Okay. So now in order to borrow this money, here you will bring the money to UK. So when you bring it to UK, you have to convert. So you have a dollar, you will sell dollar. What will the bank do? Bank will buy dollar. In return, the bank will sell pound. Pound is the commodity. Bank is selling pound. It is the ask rate. So what is the spot ask rate? 1.5905. So when they do it at this rate, $342 divided by 1.5905, you get the number over here as 215,214. You get the number as 215,214 over here, correct? All right. So once you get this number of 215,214, this is what you will be depositing in UK. So in UK, the deposit rate is 5% for 1 year. 5 into 3 by 12 is 1.25%. So when you deposit at this rate, 215,214 plus 1.25%, you get 217,904 pound. This is your assured money. Okay. And this money, when it increases to this amount, instead of you paying, whoever is your customer, he will go and pay the amount over here and you will become happy because you will assuredly pay 217,904. Hence, you can sleep peacefully. That money in the US will be settled by the customer. Exchange rate fluctuation will just depend on what is the rate today. You don't have to worry about what is the rate after 3 months. Okay, so we are done with this question. Take a minute, go through this, after which I'll show you how to write in the exam, after which we'll go to money market hedging in case of payable. All right, please go through this, friends. All right, friends, I believe you're all clear with this part now. Now I'll just show you the solution as it's there in the textbook, step by step. This is how you should write down. Since we have a receivable, we create a liability. Dollar to be borrowed will be this much. This will be converted at this much, and finally you will be ending up getting this much. Just take a minute, read through this, then we go to the next question. All right, friends. I believe we are all done with this part. Can I go to the next question now? Next question is a very good question because you have forward, you have money market hedging also, and then you have options. Options also you have at a very in-depth level. Okay, so we'll do this question now. Are you all ready? Now I believe you're all fresh. Question number 12, working note number 1, basic data. There is a payable of 364,897. And what is the duration they have given over here? The duration is going to be 6 months. 6 months time. The exchange rate is given over here. Spot rate is given. That is 1.5617 hyphen 1.5673 dollar bar sterling. Okay. Next one. 6 months forward rate is given. That is 1.5455 hyphen 1.5609 dollar bar pound. Borrowing rate, deposit rate. Then they have given data about currency options. We'll write that separately. Okay, let's do forward and money market hedging first. Then, we will go for the next one. Harsh, you have a very good point. Whether you will have a gain or loss in case of money market hedging, no, Harsh. Our objective is not to make any gain or loss. Our objective is to sleep peacefully. Are you clear with that part, Harsh, now? Okay, right. So now what I'll do is with the data that is given over here, first I will go and find out under forward market, which is a very easy one under forward market. So now here it's a payable, correct? What is the payable that we have over here? 364,897 dollar. So since it's a payable, I have to go and buy dollar and the bank will sell dollar. In return, the bank will buy pound. Pound is the commodity, so it is the bid rate. What is the forward bid rate? What is the forward bid rate? 6 months forward bid rate is 1.5455. 1.5455 is the forward bid rate. So from this, I can now find out what will be my payable in pound. So I will do a divide because if I multiply, I will get dollar square. I will do a divide. So I'll get the answer as 236,102. 236,102 pound. Part 1 is over. Take 30 seconds. Go through this. Then we'll go to part 2, money market hedging. Part 3, options. Like this, we'll do it in 3 different parts. Please go through this, friends. Fine, friends. Shall I continue now? Okay. So I think we are done with forward. Now we will write down the next one, that is money market hedging. Next working note will be money market hedging. So now when you're doing money market hedging, okay, we'll have two countries over here. First country is UK and the other country is US. You have a payable over here. How much is the payable that you have? 364,897 dollar. Payable is what? Is it a receivable? Sorry, is it an asset or a liability? Liability. So what am I supposed to do? I am supposed to create an asset. How do I create an asset? By investing or depositing. I will deposit some money in US, which along with 4.5% for 1 year, so that's 2.25% for 6 months, should give me 364,897 dollar. Am I right? So when I do a reverse working, 364,897. When I do a reverse working, I'll get 356,867 dollars. All right, 356,867 dollars is what I will get over here. All right. So then what I'm going to do is, once I get this 356,867 dollar, this money, in order to deposit in US, first what I have to do, I'll write first I need to borrow some pound. Okay. That pound I should give to the bank. Bank should give me dollar. So when the bank is taking that, it's a bid rate because bank is buying pound. Okay. So I borrow some pound, give it to the bank. Bank gives me the dollar. That dollar is what I can go and deposit in US. Are you clear? So here, what I'll do is I have to use the spot bid rate. I'll use a spot bid rate. Okay. So what is going to be the spot bid rate? 1.5455. Sorry, spot bid rate is 1.5617 dollar bar. So when I convert, I should get 356,867 dollar. I should receive this money, and this money is what I should deposit over here. Am I right? Correct. So like that, when I do, automatically what will happen? I will be able to get the money in the end. Correct. So when I do a reverse working at this point of time, the X dollar will be 356,867 divided by 1.5617. So that is 228,511. This pound I should borrow at the pound interest rate. What is the pound interest rate? 7% for 1 year. So for 6 months, it is 3.5%. I'll get 236,510. 510 pound. This is the money that will be paid by me. Paid by me, or it will be paid by A Limited. And this deposit money will be used to repay the supplier. And this money is going to be my assured money. Today only I will come to know that I will be paying 236,510. So I can sleep peacefully. Take 2 minutes time. Understand this diagram thoroughly. After this, we'll go to currency options part. All right. Yes, friends, shall we continue now? I believe you are all clear with this part now. Okay, so money market hedging is done. I'll just show you the solution part also, how the steps are coming. Since A has a payable, we'll create a receivable. In order to deposit, we need to first borrow. Okay, then it will be converted. So these are the steps. Take a minute, go through this also, because this is how you should write in the exam. You cannot write the way I draw diagrams. The diagram helps you to understand things, but this helps you to really write in the exam. Take a minute, go through this also, then we will do currency options part. All right. Fine, friends. So we are done with money market hedging. Now let's go to currency options. So I'll write down the next working note heading. Currency options. Okay. So now in currency options, first we'll write down the basic data again. Point number A. So in currency options, they have told that there is contract for GBP 12,500. So the contract size is 12,500 pound. All right. Option premium for a GBP at a strike price of $1.7 bar pound. So you have a strike price of or exercise price $1.70 bar pound. Okay. Correct. Dollar bar pound. And they have told the call premium is 0.037. Call premium is $0.037 per pound. Everything is per pound. Commodity is pound over here. And the put premium is going to be $0.096 bar pound. All right. And the duration is coming as how many months? Duration is coming as 6 months. Now the company is having three choices. Three options are there over here. First, which is the best? Forward, money market, we have done. Now we are going for currency options. So friends, when we go for currency options, from this, step number one that we need to work out is whether it is going to be a call option or whether it is going to be a put option. How to decide that? We will draw this diagram. Now what happens over here is it's a payable. So when you have a payable, what will you end up doing? Buy dollar, sell pound. What will the bank do? Buy pound, sell dollar. Exchange rate is dollar bar pound. Commodity pound, buy, and here you have sell. So basically what this means is that if it's a buy over here, this means you need to have a bid rate. Here if you have a sell means you need to have a right to sell. When will you get a right to sell? Only when you buy a put option. So here, what is your decision making over here? It will be buying a put option. Everybody clear with this part? Take a minute, go through this. Once this part is clear, I will go to the advanced level of options where we'll do number of contracts and adjustments, etc. Okay. Take a minute, go through this now. I hope the pace is comfortable, friends. All right, friends. Shall I continue now? Fine. So I think you're clear with step number one, that why it is a put option. Okay. So once you get it as a put option, step number two that we need to do over here is decide on the number of contracts. This will again make your life miserable. Now, how do you decide on the number of contracts? I'll explain that to you. First thing, we have a payable. How much is the payable that you have? $364,897 is your payable. All right. Now you have a strike price over there. What is the exercise price of the strike price? You have a right to sell it $1.7 bar pound. Correct. So if that is the case, can I find out how much will be my dollar which is payable over here? 214,645. 645 pound. All right. So once you get 214,645 pound, the next step that comes after this is number of contract or the contract size. So if I'm not wrong, in this question, the contract size is 12,500 pound. Yes. So once you get this contract size, I will get the number of contracts. That is 17.1716. Okay. So with this number, what I will do is, as I do, I'll draw a diagram. We'll find out how many contracts I can enter in the option market. Balance can either go for no hedging or forward. This question I will do using forward. Earlier question we did using no hedging. Everybody clear? So that means from this I told you there will be three layers to the diagram. First one will be number of contracts. Then you will have currency and then you will have commodity. Now what is the currency over here? Dollar. So 364,897 divided by 17.1716 into 17. I'll get the number as $361,250. Correct? And the remaining will be 364,897. 3647 if I'm not wrong. $3647. Everybody clear with this part? Okay. Once this part is clear, then I will go to the next one. The next one would be commodity. What is the commodity now? Dollar. 214,645 divided by 17.1716 into 17 will be 212,500 pound. 2145 pound. This is how the diagram comes and this is how you split the number of contracts. Take 1 minute, go through this, after which I will go to the next part. Yes, friends, I believe you're all clear with this part now. Can I go to the next one? All right. So once you're done with the number of contracts, after this, we will have the steps involved over here. So the next step will be step number 3, amount payable on put option. Amount payable on the put option. So in that case, what will happen? I think we got the number as $361,250. correct? And what is the exercise price? 1.7 divided by 1.7. When you do this, you get the answer as 2,12,500. 2,12,500. All right. Then I will write down step number 4. Okay. So step number 4 will be after this the balance in forward contract. Correct. So I think the balance number that we got was $3,647. $47. Now this will be bid rate or ask rate. I think it is a bid rate. We already found out over here. So we need the forward bid rate. So what is the forward bid rate? 1.5455 divided by 1.5455. I'll get 2360 over here. Right? Now I'll add up this and this together. Plus I'll write down step number 5. That is option premium. So did we take it as a put option or a call option? It was a put option, correct? So I'll write down my put premium. So when I say put premium, ideally my put premium will be how much? I think it was 0.096, correct? So I'll put the number over here. It will be 2,12,500 pound into 0.096 dollar bar pound. I'll get the answer as $20,400. But I'm right now in UK. So I need to convert. So using the bid rate, we already found out it's the bid rate. I will use a spot bid rate 1.5617. And then I will say how much is my put premium in pound. Okay, so that will be 2,400 divided by 1.5617, 13,063 pound. All right. So after you get this, what I'll do, I will add the interest. Why interest? Because premium is paid upfront. 2,12,500 is paid after 6 months. 2,360 is paid after 6 months. So interest will be paid upfront. Okay. So now how much is the interest that you are going to pay upfront will be on the interest rate in pound. That is 7% or that will be 3.5% into 3.5%. That is 457 pound. Okay. So in that case, what will be my final payment of premium, final premium with interest? Is it turning out to be 13,520? So friends, I have to pay this, I have to pay this, and I have to pay this. All together, if I add up 2,12,500 plus 2,360 plus 13,520, you get the number as 2,28,380 pound. Okay. So this is how we solve this problem, friends. We are done with this heavy question. Please do it yourself now. I'll give you a minute's time. This being a heavy question, I'm going a bit slow. Once you are comfortable, I will go to the next question. So take a minute, take 2 minutes. Understand this thoroughly. Any doubts you can put in the chat box. All right, friends, I believe you're all done. Indra, you want me to explain the interest on put premium? Indra, that 2,12,500, this money is paid now. Sorry, this is paid after 6 months. This is also paid after 6 months. But this money is paid now. So can we add up these three numbers? No. So this I will borrow at an interest. So after 6 months, I'll pay how much money? I will pay 13,520. Are you all clear with this part now? So friends, we are done. How do we get to know that interest to be charged on premium? Premium is always paid upfront. Okay, so when you're doing a question like this, remaining everything, this is 6 months, this is also 6 months, so this should be also after 6 months only. I hope you are clear with this part now. So friends, we are done with money market hedging and we are also done with put premium and option strategy. All right. Now we go to the next question, which is a question on transaction exposure and operating exposure. Correct? Okay. So here basically let me explain to you. Transaction exposure means what is your profit now versus what is your profit later. Operating exposure is also the same thing. Profit now versus profit later, but after considering price elasticity. Everybody clear with this part? I think you'll understand it better when we do this question. Let's take question number 13. Working note number 1. Basic data. Now here, he is basically doing what? He is Omega is exporting air conditioners to Germany. So this fellow is actually in India. From India, he is exporting to Germany after importing from Singapore. After importing from Singapore. All right. So Singapore to India and then from India it is going to Germany. Are you clear with this part? So he is exporting 2,400 units. 2,400 units and the selling price is 500 euro. His purchase cost is 800 Singapore dollar. And he's got a fixed and variable cost of 1,500. That will be 2,500. Okay. Now they have given you the spot rate and they have given you the rate after 6 months is also given over here. All right. 2,500. Spot rate is given after 6 months rate is given. So how do you find out the transaction exposure? Profit now versus profit later. So with this data, what I will do is I'll draw a table now. I'll give a heading. Transaction exposure. I'll draw a table over here now. Particulars. Profit now versus profit later. So first I will have to put the selling price. So what is the selling price I have? 500 euro. So when they sell, I will receive euro. This euro I will give it to the bank. Bank is buying euro. So what will be the rate? Bid rate. So what is the spot bid rate in the question? 51.5. So what is 500 into 51.5? 25,750. 500 euro into the bid rate. After that, I will take the purchase cost. So if selling is bid rate, by default, my purchase will be what rate? It will be the ask rate. So 800 Singapore dollar into the spot ask rate is 27.25. That will be 21,800. All right. Now, apart from this, what do I have? I have the variable cost and I have the fixed cost. That turns out to be 2,500 rupees. Once you do this, from this I can go and find out what is going to be my profit per unit. Do I get the amount as 1,450 over here, friends? Correct? So from this 1,450, I will put the units and the units is I think 2,400 units. Correct? So I can just find out what is my total profit now. So my total profit now would be 1450 into 2,400. That is 34 lakh 80,000. Later on, let's see, 500 euro into, I will use my forward bid rate now. My forward bid rate is how much? 52. That is 26,000. 800 into my forward ask rate. 27.75, that is 22,200. This will remain the same. I'll get the balance number as 1,300 over here. I have 2,400 units. This into 2,400 units will be 31 lakh 20,000, correct? So once you take this, we'll get the net gain or loss as how much? 3,60,000. This is what we call it as transaction exposure. Okay, take a minute, go through this, then we go to the next part. Ashwin, your doubt is that put premium is based on the number of options. It is based on the number of it's based on the pound, the commodity. So here the commodity is pound, right? So it's based on pound. Whatever is the commodity on that, the premium is $0.096 per pound. Okay. Fine, friends. I believe you're all clear so far. So we are done with transaction exposure. Now we go to the second part of the question where they say based on the following additional information. So now what are they doing? They are providing you with some extra information. They want you to find out the gain or loss due to transaction exposure and also due to operating exposure. So here you need to find out using transaction also, operating also. So I'll again put the same table, particulars. Now, then you have 6 months. All right. So first thing is selling price. Now they have told the contracted price of AC is 25,000. Contracted price of AC is 25,000. The current exchange rate is turning out to be 51. Okay. So the spot rate is changing, but the forward rate, nothing has been told, which means forward rate will remain the same. Are you all clear with this part now? Okay, so now selling price is written. Next part is going to be what? It will be the purchase cost. Purchase cost. Okay, so when you go for purchase cost here, you will get the number as I think it will be 800 into the ask rate. So the spot ask rate is 27.15. 800 into 27.15 will be 21,720. 6 months forward rate remains the same. It will be 22,200. After this, you have the variable cost and also the fixed cost, correct? So that turns out to be 2,500. Once you put up this, then you will have the profit per unit. You get the profit per unit as 780 over here. And you get 300 over here, correct? And what was the number of units that you had? 2,400. All right. So 780 into 2,400 units will be 18,72,000. Other one will be 7,20,000. Okay. So when you take the difference over here, do I get the answer as 11,52,000? So this is going to be my transaction exposure. Okay. Take a minute, absorb this, then I will show you operating exposure. Anirudh, I'm reading your message now. I have done that question in the earlier marathons. Today, the last day, adding more questions will put more load. We have already planned a lot of questions and it will go up to 11:30 or 12 also. Students will get exhausted. So I don't think I can do it now. You work it out yourself. If you face any doubts, WhatsApp me. I will surely clear it up for you. Okay. Yes, yes. Early payment question also was done in one of the earlier classes, and today we have done a cancellation question also. Okay. Right. So I believe you're all clear with this part. Can I go to the next one now? Okay. Right. If you want early payment question, if you want, I will do it in the end. If we get time, we will do that. All right. So I think that's a very interesting and a good question. We can spend time on that question if required. All right. Now, please interact with me. So we are done with transaction exposure. Now we are entering into operating exposure. So friends, even before we enter into operating exposure, this is nothing but the same as transaction exposure except for price elasticity. So we need to focus on price elasticity over here. Particulars, now and then you have 6 months. All right. So in this, I'll write down selling price. So I know the selling price being frozen at 25,000, there is no change. Sorry, all this is already done. Let's not work on that. We have found out the profit per unit, correct? So what was the profit per unit that you got? 780 and 300? Profit per unit. Then you have the number of units, correct? As of now, the number of units is 2,400. But later on, due to price elasticity, your number of units might change. That is what will give you the operating exposure. Okay. So now in order to get this, I need to first decide from the German fellow's point of view whether for him it is going to be a bid rate or whether it is going to be an ask rate. So I'll just draw a chart here, German, and then you have the bank over here. So what is a German going to do? He has to buy. So when he buys, he has to make payment. For making payment, he needs rupee, correct? So for making payment, he needs rupee. So what will he do? He will buy rupee. In return, what will he do? Sell euro. What will the bank do? Buy euro, sell rupee. And I think the exchange rate over here is rupee bar euro. So what is the commodity over here? Euro. Buy euro. What rate is applicable over here? It will be the bid rate. Are you clear so far? So now I will show you how this is going to affect him. Point number A, what is the euro to be paid today? 25,000 rupees is what he has to pay. And I think it is a bid rate, correct? So today, what is the spot bid rate? 51.75. So do I get the answer as 483.09? 483.09 euro. Euro to be paid after 6 months. That is 25,000 rupees into the forward bid rate. How much is the forward bid rate? It is 52 rupees bar euro. Do I get the answer as 480.76? 480.76. All right. So from this, can I find out what is the percentage fall in the price that you have from 483.09 minus 480.76 divided by 483.09. When I do, I get the fall of 0.48%. Now they have told the price elasticity is 1.5. What does that mean? For every 1% fall in the price, demand will go up by 1.5%. So percentage rise in the demand. So what will be the percentage rise in the demand? 0.48 percentage into 1.5. That is 0.72%. So once I do this, can I go and find out what is going to be my revised demand over here? So that would be 2,400 plus 0.72 percentage. Do you get the answer as 2417 units over here, friends? 2417 units. Everybody clear? So then I'll come back over here and here I will write 2417 units. If you see 780 into 2400 was 18,72,000. 300 into 2417 will be 7,25,100. Do you get the answer as 11 lakh 46,900 based on all these things? This is going to be your operating exposure. I'll give you a minute. Please go through this now. Anirudh, great to know that we are doing the same question exactly now. I couldn't recall which question was there in the RTP, but the whole plan would have gone upside down. Sorry if I couldn't do it when you told me. Okay. Go through this also, then we will go to the next question. Okay. All right. So now I'll repeat. Okay. When the price elasticity is from the German point of view. So German is going to buy rupee because he needs to pay us in rupee, correct? Because in second case they have told it's home currency invoicing and the selling price will be flat 25,000 rupees. So the exchange rate fluctuation will fall on the German fellow. Now the German fellow wants to buy rupee. So because he wants to buy rupee, okay, in return what will he have to do? He will have to give euro. Am I right? So it's a bid rate because the bank is going to buy euro and the German is going to give euro to the bank. All right. Yes, friends. So I think you're all clear with this part now. Did you go through this also? Perfect. So we are done with this question on transaction exposure, operating exposure. Now we will go to the one next question which conceptually covers everything, but we may have to work out one or two extra questions to get more grip on the subject. All right. Nostro, vostro. So friends, in this question, you need to understand that there are two positions. The first position is what you call it as the cash position. Inside the cash position, you will have a debit and you will have a credit. Then you have something called as the exchange position. In the exchange position, you will have a buy and then you will have a sell. All right. So now what happens is, here you will have only the real transactions. Here you will have both real as well as imaginary transactions. And one connection that you need to always keep in your mind is that whenever there is a deposit that is coming in the cash position, okay, that is credit. When it comes as credit over here, deposit will come only when you sell dollar. Am I right? Sorry, or only when you buy dollar. First you buy dollar, then you deposit, correct? So always remember, if there is a credit in the cash position, you will surely have a buy in the exchange position. Same way, if you have a debit in the cash position, you will always have a sell in the exchange position. Alternatively, they can do it and just stick to one answer. This is as per study material, what I have done over here. All right. Yes, Harsh, I went through the MTP question. There is a mistake over there. So if we simply go into a wrong question now, it will create more confusion in your mind. That question is similar to what we have done over here, correct? So let's stick to this question itself. All right, Harsh. Now, last minute changing something what I will not recommend. If it was 15-20 days before the exam, yes. One day before the exam, you going for tricky questions or confusing questions that will demoralize you, it will affect. Let's not do that, Harsh. All right. Yes. So cash position and here you have the exchange position. Are you all clear with this part? Yes. So now they have told balance in the Nostro account is 1 lakh credit. Opening position overbought is how much? 50,000 overbought. So these two things are given. Purchase the bill on Zurich. So purchase the bill on Zurich means you have to buy. Okay. Real or imaginary? Bill is imaginary. So will it come in cash position? No. It will come only in the exchange position. All right. Sold forward TT. Real or imaginary? Imaginary. Only in the exchange position it will come as sell. Forward purchase contract cancelled. Again, imaginary. Only in the exchange position it will come as sell. Remitted by TT means making payment. So it's a real transaction. It will come as debit in the cash position. So whenever you have a debit over here, correspondingly, what will you have over here? You will have a corresponding sell. Just confirm. Yes, debit will be corresponded with a sell. That's because you have to first sell the dollar. 1 minute. Yes, you should have a sell. I'll cross check that part, friends. 1 minute. 75,000 exactly. It will come as sell over here and remitted by TT. It will be a debit. All right, everyone clear? And the last part that you have over here is draft on Zurich cancel. That is the only one tricky part that you have. Draft on Zurich cancelled. Draft on Zurich cancelled. So when you talk about the draft on Zurich that is cancelled, here we'll take the original position or original action that was taken. Originally, what would have they done? They would have taken a DD on Zurich. Zurich is a place. This is real or imaginary? Imaginary. So ideally, DD means you have to make payment, correct? So if it was real, it will come on the debit side. Corresponding action will be what? Sell. So here also, what will be the ideal action? Sell would be the action. Now what is happening? This contract is what you are trying to cancel it. So how will you cancel it? You will enter into a buy action. Are you all clear with this part now? Let's go and check. It has come as buy. Now just read through this. Opening position overbought already given. Purchase the bill on Zurich, buy. Sold forward TT, sell. Forward purchase contract cancelled will come in sell. Remitted by TT, I told you it will come in sell. And DD cancelled 30,000. Okay. And then in the real position, so you have a 5,000 oversold over here. Here you have only one remitted by TT as a real transaction. Closing balance is 25,000. Take 1 minute, go through this. Then I will explain the final part and we'll go to the next question. Harsh, you want me to explain the draft on Zurich once again? When you take a DD, if it was real, I repeat, when you take a DD, if it was real, it will be a balance going from my bank account. It will come in debit. If it was real, it will come in debit, correct? Corresponding to debit, what is the action in the exchange position? Sell. So since DD was not real, the only action taken in the original position was sell. Now the DD got cancelled. So what will you do? You will enter into a buy. Are you clear now? Now let me just go to the next part. So this part is clear. Now this is the cash position. This one is easy. After they did this, then they are asking in the question that they want to have overbought position of 10,000 and a credit balance of 30,000. How do they do that? Here you have 5,000 oversold and this is 25,000. So first what they will do, they will deposit 5,000 real. The moment you deposit 5,000, this will become 30,000. That's what they did. And that 5,000, the moment it comes, this oversold will become zero because oversold is there, you will buy. If you're depositing means you will have to buy, correct? Credit corresponding to buy. So this will become zero. After that, you will buy forward 10,000. The moment you buy forward 10,000, it will become overbought at 10,000 Swiss francs, friends. 1 minute, Harsh. Debit and buy are not connected. Debit and sell are connected, Harsh. I think you went wrong there. Debit is connected with sell. Okay. Yes, friends. So this is the last part. Just read through it once. I'll give you 30 seconds. Then we go to the next question. I'll explain this once again. So here you have 25,000, correct? So what you'll do over here is you will deposit another 5,000. The moment you do this, this will become 30,000, correct? This is a real transaction. And deposit means it will come on the credit side. Credit corresponds to what? Buy. Since credit corresponds to buy, over here you will have a buy 5,000. So oversold and buy net effect will become zero. After this, what will you do? You will again buy in the forward market how much? 10,000. The moment you do that, you get 10,000 overbought, and along with this, you will be having this 30,000 over here. Are you clear now? So friends, we are done with this question also. So friends, conceptually, this chapter is actually over. Now there is only one question where you have an early purchase, which we will do it now itself. I think that question is important. Let's work out that question. It's there in the ICI study material. I had done that in one of the crash courses earlier, which I conducted with Logic a little while back. But I think we'll do it again. Quickly, we'll do that. I think it was illustration number 4, if I'm not wrong. I think. Okay, yes, we got the question. Illustration number 4. Okay, I had done this in my crash earlier, but I'll just do it quickly now so that if anybody has missed out, you can do it. Okay, so I'll just take this part. On October 1, 2015, Mr. X, so I'll draw a diagram. Okay, October 1, 2015, Mr. X, an exporter, enters into a forward contract with BNP Bank to sell $1 lakh. So here it is doing what? He's going to sell $1 lakh at the rate of 65.40 rupees per dollar. All right. Once you're done with this, then they say at the rate of 65.4. However, due to the request of the importer, Mr. X received the amount on 28th November itself. This was actually supposed to happen on what date? December 31st. But he got the amount on what date? 28th November itself. The interbanking rates on 28th November was given below. So now what will happen? If you want to cancel this, you will cancel how? You will buy $1 lakh. How many months forward? 1 month forward. So when you buy, at what rate will you buy this? At the rate of ask rate, because you're buying, the bank is selling ask rate. So 1 month forward ask rate, that is 65.27 plus 15, that is 65.42. You're going to buy it back, correct? So like this, it gets nullified. So what happens? You sold at 65.4, bought back at 65.42. So what is actually the loss that you're making over here? 65.4 minus 65.42 into $1 lakh. So do you make a loss of 2000 rupees over here? Correct? That is step number 1. Your textbooks have done it slightly differently, but let us do it together and clarify it in my style so that you become clear about how we are going forward with this entire thing. Everybody clear? So you make a loss of how much over here? 2000 is going to be your loss in this scenario. Now, what your textbooks have done is they have taken a loss of 20,000. How they got this 20,000 is because after they do this, next step, what will they do? They will sell spot, correct? So now when they sell it spot, they will be selling $1 lakh at the spot bid rate. What is the spot bid rate? 65.22. So here you get 65.22 lakhs. So I'm not going to go by as per how your textbooks did. I'm trying to do it in a slightly different manner, but you will get the same answer. All right. So what I'll do over here is I'll take a fresh page and here I'll write down sell at 65.22 lakhs. But you have made a loss of how much? 0.20 lakhs, I think. No. 2000. So it will be 0.02 lakhs. Okay. So now tell me, when you put up these two things, what is the net amount that you get over here? Do you get the amount as 65.20 lakhs? This is the same answer your textbooks have also got. They got 20,000 over here. And then what they have done, they have just come down and I'll show you how they have done it. They got 20,000 over here. Swap loss 20,000. And they have taken the received amount on sale as how much? 65 lakh 40,000. So now tell me, when you take 65 lakh 40 minus 20,000, what is the answer you get? 65 lakh 20,000, correct? Same thing I have already got. So they are only doing it in a slightly different manner. So I was thinking, let's not waste your time doing like that because you get confused. This is a logical way you have learned. First, what are you doing? You sell. Then you do buy. So you make a loss, 2,000. Then you sell at 65.22. So you get this minus this will give you the answer. Very, very simple. If you're clear till here, I'll give you a minute, read through this. Then I will go to the next part. Fine, friends. I believe you're all clear so far. Now comes the last part, that is interest on outlay of funds. That part is the confusing part in this particular question. So, what they are telling over here is that as a customer, I'll just put the steps first. As a customer, today you have sold at what point? 65.22 lakhs. Okay, that is the first step. November, they're saying the bank sells. Okay, I'll do one thing, I'll draw the diagram so you understand it better. Here you have a tall customer. Here you have the bank. Here you have a London bank, correct? So on the first day, what was the original transaction? He is selling at 65.4. What is the bank doing? Bank is buying at 65.4, correct? After this first step got over, what is happening? He is going to the bank and he's buying at 65.42. This was unexpected actually. Okay, and on the same day, what is he doing? He is selling at 65.22. And what is the bank doing? Buying at 65.22. If the bank buys at 65.22, this is a real transaction, correct? Rest are imaginary. So what does the bank have to do? Bank will have to cover up the position. How will the bank cover up the position? Immediately the bank will go to the London bank and the bank will sell to the London bank at whatever is the bid rate. So what is the bid rate of that date? Sell at, minute. It will be the same thing. It will be the same amount, 65.22. That is how the bank will cover up its position. So now what happens over here, if you see, is that bank is buying at 65.4. Bank is selling at 65.22. Due to this, okay, so I'm just highlighting this part, this buy, and here there's a sell, due to which the bank is making a loss of 0.18 into $1 lakh, that is 18,000 rupees. This loss will outstand only for 1 month because after 1 month, anyways, the contract will get nullified. For this 1 month, on this 18,000, you will be paid an interest of 18%, that is for 30 days. That is 266. I think it's 360 days in 1 year. Have they told like that? Let's just double check how the question has done it. 31 days. Okay, I have taken 30 days. They have taken 31 days. 31. So 18,000 into 18% into 31 divided by 365. So you get the answer as 275. This is what they call it as interest on outlay of funds. So it's basically the loss the bank suffered because the customer came early. Take a minute, absorb this. Then we'll go to the next one, major question of London, New York, Frankfurt, and mostly with that we'll pack up today's session. Okay, please go through this. Ruben, I'll explain the diagram once again. So here what have you done? Initially, we sold at 65.4. The bank has bought at 65.4. Subsequently, the bank, we have cancelled by buying at 65.42. Bank has sold. Then we sold at 65.42. Bank has bought. This being a real transaction, this is the action to cover up. This is the covering up of the position. Okay. So now what happened is bank is saying I bought over here at 65.4. Then I sold over here at 65.22. Because of this, I made a loss of 18,000. This loss will be there only for 1 month because after 1 month it will get nullified. So in that case, for that 1 month, my interest on outlay will be 275 rupees, which the customer is supposed to pay me. So now what happens? Customer has to get 65.20 minus 275 rupees. So 65 like 20,000 minus 275 will be 65 19 725. Okay. Yes. Take a minute more, absorb this. This was a little tricky problem, friends. We'll do one more question and we'll pack up today's session. Hats off to the balance 40 people who are attending it live. We started with around 100. Now the numbers have come down. That shows your dedication and determination. Others might have slept. They might be getting up in the morning and watching it. But hats off to all of you 42 people who are attending it live and taking so much of efforts. I really respect you. Please finish this and then we go to the final question for today. Yes, friends. So we are done with this also. Now, shall we go to that last one question? There are some questions I have kept pending in between, friends. They are all same type questions now. Okay. So conceptually, everything is covered. So now you have 15. Let's check. You have 16. Then you have some extra. Yeah, 16 is what I want to work out now. Then you have some practice questions. You have got one, two. How many are there? Let's check. You have eight more questions you are having extra. Friends, so my just request is we'll now do this London Frankfurt also. So you will have around 9 questions to be done from your end. I'll tell you how to do it now. Don't do it today. Go and sleep. Just do 4 questions tomorrow, remaining 4 or 5 questions on the last day. So like that, you'll be in touch with Forex for all the 3 days. Today, tomorrow, day after tomorrow. And that should not take more than 40-45 minutes of your time. Scribble and solve. Read and solve is also enough. You don't need to work it out. They are all repeated questions of the same type. 16 is a very tricky problem. So I thought we'll do it now. So shall we do it together, friends? Are you ready? Okay, let's do it. So now your bank's London office is having surplus funds of 5 lakhs. So I'll write down working note number 1. Basic data. Point number A is having 5. What is the question? Question number 16. Okay, so you'll have surplus funds 5 lakhs. 5 lakh for a period of how many months? 3 months. All right. The cost of funds to London to the bank is 4%. Cost of funds is 4%. It proposes to invest these funds in London, New York, or Frankfurt and obtain the best yield without any exchange risk to the bank. Okay. So now the following rates are the of interest are available at 3 centers. So 5%, 8%, 3%. Down they have given you the spot rate, 1 month forward rate, and they have given you the 3 months forward rate. Here is the challenge. They've used the word London or New York. Suddenly, when you look at this, it's so difficult to understand what is the exchange rate. So I'll just explain that to you, friends. London or New York, basically means dollar bar pound. London or New York. When you read it literally, it's the other way around, but you can use common sense also. Pound is more powerful, so it is this dollar bar pound. If London or New York is like that, can you tell me what will you mean by London on Frankfurt? It will be Euro bar pound. Correct? London on New York was dollar bar pound. Correct. It will be Euro bar pound. Are you clear with this part now? Now you're asking whether I should invest my money in London or New York or Frankfurt. Okay, so shall we do it together now? Right. So I'll just say next working note I'll write down invest in London. Invest in London. So now tell me what is the surplus money that is available with you? 5 lakh dollar. First thing I'll have to convert the dollar into pound. How will I do it? I will sell the dollar. Bank will buy the dollar. Bank will sell pound. So it is going to be the spot ask rate. What is the spot ask rate? Let's check. 1.5 dollar bar pound, right? Yes. 1.5390. Okay. So now here it will be 5 lakh divided by 1.5390. How much is a dollar that you get with you now? Sorry, pound that you get with you now. 3,24,886 pounds. All right. Thank you so much, Bincy. Now, once you get this, on this, we will get interest in London. What is the interest in London? Everyone tell me. 5%. 5% for 1 year, correct? So I think you get 1.25%. You get the closing balance plus 1.25% will give you the closing balance as 328,947 pound. Okay. Let me confirm this again. Yes. Now what they do is they have taken a concept called as opportunity cost. What they're telling over here is that this 5 lakh dollar which I had, I could have invested at 1%. Sorry, that is I could have invested this at 4% because the cost of fund to the bank is 4%. 4% for 1 year. So for 3 months, it will be 1%. I would have got 5,05,000 had I converted to pound at that time. I would have sold the dollar, bank would have bought the dollar. In return, the bank would have sold pound. So it's the ask rate. It should be the ask rate, but unfortunately, your textbooks have taken the bid rate and they have given a note. It is due to conservative outlook. Alternatively, you can do it as ask also, but the textbook I've done using bid. I'm doing bid, but bid is actually wrong. We should take ask rate. So what is this? The forward bid rate? 80 is the point. So 5350 plus 80. That is 5430. Bracket you can give bid rate due to conservative outlook. All right. So in that case, the answer would be 5,05,000 divided by 1.5430. 3,27,284 pound. Correct? Minus 328,947. That will be 1,662 is going to be your gain in this part. This is the answer you get if you're investing in London. Take a minute, absorb this, then I will show you about New York and then about Frankfurt. Ruben, ideally you should be able to take ask also because that's one of the alternative solutions, but textbooks have done using bid. Okay, so I just wanted to, if the question comes, this one comes in exam, it will be the same thing. They will not change it. But it's in that case you use bid and finish it off. Why to take chances? The value will have the answer key. So in that it's showing bid rate, you take ask, it will create confusion. Okay, so I think you're done with London. Next part is invest in New York. Invest in New York. So when you're investing in New York, what is the surplus money available with you? 5 lakh dollar, correct? On this, in New York, what is the rate of interest that you're getting? 8%. 8% means it will be interest at the rate of 2%. Am I right? So what will be your closing balance that you get over here? 5 lakh 10,000. Now let us check the opportunity cost. 5 lakh dollar plus 1%, that will be 5 lakh $5,000. Right? Now, when you take the difference between this, do you get the difference as $5,000? That is your gain. So this again, what will you do? You will sell. Bank will buy. In return, the bank will sell pound. It will be the ask rate. So what is the ask rate after 3 months? Dollar bar pound ask rate after 3 months, 85. So 5390 plus 85. This 5475. 1.5475. 3231 will be your profit when you do it like this. So we have covered the second part also, friends. First one was 1662. Here you get a better profit. Take a minute, go through this, then we go to the final one, that is Frankfurt Euro. Rehan, the answer is different in ODB. Let me cross check. 1663 is correct. 2279 is it? How did they get that number? Okay, it's just I think a rounding off difference. No, 5 lakh 10,000. They have taken the bid rate again. That's right. Okay, ignore this part. I need to change it from my ODB. Your textbook is as per what I have done over there. This needs to be changed. Okay, this is also correct if you assume the same bid rate, but your textbooks have not done like that. They have taken the way I have done on the board now. Okay, I'll change this part. Thank you for letting me know. Now we go to the last and the most tricky part, that is Frankfurt. Are you ready for Frankfurt now? Fine. So what is happening in case of Frankfurt is that first I have surplus money. How much is my surplus funds? 5 lakh dollar. So I need to convert this into euro. In order to convert this into euro, I need the spot dollar bar euro or euro bar dollar. Now tell me, okay, now tell me, hold on. Harsh, it's correct in your ODB. Hold on, I want to understand. This is the latest one that I've opened over here. In this PDF, the answer is like this. Harsh, is your answer in this manner or is it in the other manner? Harsh, if possible, can you take an image of that and WhatsApp me? If possible, okay? Right. So now, spot dollar bar euro is required, but I don't think in the question they have spot dollar bar euro. Just check. No, they have dollar bar pound, they have euro bar pound, but they don't have dollar bar euro. So for getting this, I need to first decide its bid rate or ask rate. So what happens? Surplus fund is 5 lakh. I will give 5 lakh. Bank will buy 5 lakh. Bank will sell euro. So bank selling euro, euro being the commodity, ask rate. So the equation will be spot ask dollar bar euro is equal to spot ask dollar bar pound into spot ask pound bar euro. Correct? So what is spot ask dollar bar pound? Spot ask dollar bar pound 1.5390 into spot ask pound bar euro. It is euro bar pound. So 1 divided by bid. 1 divided by bid 1.8260. So what the number I get? 0.8428. 0.8428 dollar bar euro. Once I get this, okay, I will just convert and I will tell what is my surplus euro. My surplus euro will be 5 lakh into, sorry, divided by 0.8428. So I'll get 5 lakh 93,260 what euro. So once I get this, I'll add the interest now. What will be the interest rate? In Frankfurt 3%. So 3 into 3 divided by 12 will be 0.75 percentage. €597,709. Okay. Now I'll do what? I'll convert this into pound now. So I will give euro, bank will buy euro, bank will sell pound. So pound being the commodity, ask rate. What is the 3 months forward ask rate? Ask rate of euro bar pound 140. 8290 plus 140. 8430. 1.8430 euro bar pound. So when I convert 597,709 divided by 1.8430, you will get 324,313 pound. This is the closing balance in pound. Less we have the opportunity cost. We had already found out the opportunity cost earlier. 327,284. I think I have done some mistake, friends. Hold on. I think I have done some mistake. One minute. 5 lakh euro, sorry, dollar divided by 0.8428. That's correct. 593,260 is correct. Plus 597,710. Then I need to convert this back. So I will sell euro, bank will buy, bank will sell. It will be the ask rate. 3 months forward ask rate. Correct? 3 months forward ask rate is 8290 plus 140. That is 8430. Then you will divide. It is 8150, is it? 8290. Oh, it's descending order. Okay. 8150. That's where I went wrong. Thank you for letting me know. It's in descending order, so we should subtract. Thank you so much. Euro bar pound. 597,709 divided by 1.8150 will be 329,316. 329,316. Okay, minus 327,284. That will give me a profit of 2032 pound. So out of these three, the best answer will be invest in dollar. Let's just confirm 2032 is correct. Yes, that is correct. So this is how you do Frankfurt. Frankfurt was tricky, friends. Take a minute, go through this. With this, we'll be wrapping up our session. Okay. All right, friends. So I am done with this question also. And with this question, I am done with today's Forex Marathon. I'll take this PDF, I'll convert it into PDF and share it in the mentoring group that we already have right away now. If any one of you are not joined the mentoring group, just WhatsApp me on my number. I will add you. This is my number. Okay. Thank you so much for your patient listening, friends. Time is almost 12 o'clock. We spent 4 hours and we have covered the whole of Forex. There are some 7, 8 small questions left for you to do. Scribble and solve. Do 45 minutes tomorrow, 45 minutes day after tomorrow. Like that, you will be in constant touch with Forex, and at least that 8 to 12 marks of Forex you will surely get in the exam. Plus, along with Forex, tomorrow you're going to cover the easy topics. That easily you'll be able to score good marks, friends. The order that I gave you: mutual fund, bond valuation, share valuation, merger valuation. By afternoon, you are covering a major chunk that will come for at least 50 marks in the exam. That plus a 10 to 12 mark of Forex means 62 mark is covered by tomorrow afternoon. Okay. And last day, 9 o'clock, you'll finish off with derivatives. So 9 to 12 will be theory. That will again help you to score another 20 marks. So 82 is done in the major morning chunk itself. Then what is left? Portfolio, advanced capital budgeting, derivatives. These three topics will cover another balance, whatever marks is coming. That also you will be able to do really, really well. Hold on. Yes, I believe you can see me, right? Yes, you can do very, very well. So with that, I can be sure that this exam will go very good for you, friends. I have been working with you as I promised in my classes also. So please study well. I am with you. Let's work together. Let's win together. So with today, my mentoring also for May 25 gets over. Very soon I'll announce for September, but May 25 is over. I have done all my part. I hope you have done your part also. Together, we will win. Thank you so much, friends. Thanks a lot, everyone. Please study well, and please do one favor to me. Please like this video if you genuinely felt this is useful and helpful to you, and also share it with your friends so that others can also benefit. Thank you so much, friends. Study well. All the very best for the examination. Go and give your best. Take care, friends. Have a nice time. Thank you so much, Harsh. I'll check that. Thank you, Aishwarya. Thank you, Rihas, Ashik, Ruben. Thank you, Ruben. Thanks a lot. Thank you, Anirudh. Thank you, Mugdha, Aishwarya, Indra, Shreyas. Yes, I am your win-win buddy. That's what I promised in my class. That's what I will keep up always. Thank you, Renisa. Take care. Take care, friends. Do well. Okay. Thank you so much, Anu. Okay. Go and have some good sleep. Tomorrow will be a wonderful day for all of you, friends. Take care. Okay. Take care.